Hello, welcome to revision of leverage today first. So first we will revise leverages and then we will take some very important questions. Okay, are you ready?
Yes, sir.
Yes. So write down. I will give you all the formulae required in this chapter at one place. So what is leverage? Use of one financial variable to influence the other financial variable. How many types of leverages are there? Three types of leverages. Leverage is the study of risk. So one is operating leverage. It deals with operating fixed cost. It deals with operating fixed cost. It measures business risk. This was first one. It measures business risk. It measures impact of change in sales on EBIT. Okay. So it connects two variables, sales and EBIT. How much sales would impact EBIT? Formula. First formula is percentage change in EBIT upon percentage change in sales, and the second formula is contribution upon EBIT or contribution upon sales minus contribution upon contribution minus operating fixed cost. So sometime you have to find some missing figure. So you should know what is EBIT, contribution minus operating fixed cost. Is it right? Then another formula, related formulae, which you have to know for solving the question. Percentage change in sale sales multiplied by operating leverage will give you percentage change in EBIT. Correct? If sale changes by 1%, operating leverage is 5, EBIT will change by 5%. Then percentage change in sales is equal to percentage change in EBIT divided by operating leverage. Reverse. If percentage change in EBIT is given, operating leverage is given, we can find out the percentage change in sale. Then we have profit volume ratio. Profit volume ratio formula is contribution upon sales. into 100. Then we have break even point. Break even point in units is equal to operating fixed cost divided by contribution per unit. Break even point in rupees is equal to operating fixed cost divided by profit volume ratio. Contribution equal to sales minus variable cost. Sales minus variable cost. EBIT equal to contribution minus operating fixed cost. Contribution minus operating fixed cost. And then you can play around this formula. Okay? Yes. Say yes. Yes. Please note down, those who are interested candidate, please note down. Right? One more write down. One more write. Percentage. Write down break even sales into PV ratio will give you operating fixed cost. Will give you operating fixed cost. So sometimes they can ask you this also. Is it right? Then write down one more related formula. Margin of safety. Margin of safety sale is equal to actual sale minus break even sales. Margin of safety percentage is margin of safety divided by actual sales. Margin of safety divided by actual sale. Operating leverage is 1 upon margin of safety percentage. Operating leverage is 1 upon margin of safety percentage. So sometime in some question margin of safety will be given 0.5. So 1 divided by 0.5, it means operating leverage is 2. Is it right? If there is no fixed cost, operating leverage will be one. If there is no fixed cost, operating leverage will be 1. If sales are greater than break even point sales, operating leverage will be positive. If sales are below break even point sales, operating leverage will be negative. All these basic points you have to keep in mind. one day before the exam, you can just quickly revise. If sales equal to BP, operating leverage is undefined. Operating leverage is undefined. If sales equal to 0, operating leverage is 0. Operating leverage is 0. Is it right? Up to this you have written. Now write down the heading. Point number 2, financial leverage. Financial leverage. It measures the impact of change in EBIT on EPS. So here we have EBIT, here we have EPS. Financial leverage deals with the change in EPS due to change in EBIT. It deals with fixed financial cost. For example, interest and preference dividend. It is an indicator of financial risk. Financial leverage is an indicator of financial risk. Higher the financial leverage, higher the financial risk. Higher the financial leverage, higher the financial risk. Any query on this discussion till now? So now we'll see the formula. Have you noted in good handwriting? One day you have to revise also. So if you are having less time before the exam, these notes you will revise. Okay. Higher the financial leverage, higher the financial risk. Now write down formula. Financial leverage equal to EBIT upon EBIT minus interest minus preference dividend upon 1 minus tax rate, or degree of financial leverage is percentage change in EPS upon percentage change in EBIT. Interpretation. Interpretation of financial leverage. If EBIT changes by 1%, by what percentage EPS would change? By what percentage EPS would change on the screen? Any query? If there is no preference dividend, if there is no preference dividend, then financial leverage is EBIT upon EBIT minus interest, or you can call it EBIT upon EBT. Is it right? But please remember, if you have preference dividend, use the main formula at the top. Percentage change in EPS if you have to find, then you will take percentage change in EBIT multiplied by financial leverage. Many times in the exam they will give you, if EBIT changes by 10%, by what percentage EPS will change? So 10 multiplied by financial leverage. Reverse also, if EPS doubles means EPS increases by 100%, then by what percentage EBIT should change? So reverse working also we can do. Percentage change in EBIT required will be percentage change in EPS upon financial leverage. Is it right? If they say that if you have to bring EPS down to 0, bringing EPS down to 0 means 100% decrease in EPS. Then you will apply this formula and find out the decrease in EBIT required. Okay. You can write DFL, you can write FL, doesn't matter, right? Now next is financial break-even point formula. Financial break-even point means that level of EBIT at which EPS is 0. That level of EBIT at which EPS is 0. So this is equal to interest plus, come on, preference divided by 1 minus tax rate. Is it right? Now write notes. If EBIT is equal to financial break-even point, degree of financial leverage is undefined. Is it right? If EBIT is greater than financial break-even point, then degree of financial leverage is positive. In bracket greater than 1. Greater than 1. If EBIT is less than financial break-even point, DFL is negative. If EBIT is equal to 0, what will be DFL equal to? 0. EBIT upon EBT. If EBIT numerator is 0, answer will also become 0. If there is no interest or preference dividend, if there is no interest or preference dividend, degree of financial leverage will be equal to 1. Degree of financial leverage is equal to 1. Note, if question states that EPS doubles it means 100% increase in EPS. If the question says that EPS will double, it means 100% increase in EPS. Again write. If question says EPS becomes 0, if the question says EPS becomes 0, it means EPS will decline by 100%. It means EPS will decline by 100%. Next note, write down. For each level of EBIT, DFL will be different. For each level of EBIT, DFL will be different. Then write down, as EBIT increases, DFL decreases because risk reduces. Okay, right. So this was about financial leverage. Now write down point 3, combined leverage. It measures total risk. It measures the impact of change in sales on EPS. That means this will measure if sales changes by 1%. So what is the interpretation? If sales changes by 1%, by what percentage EPS will change? By what percentage EPS will change? It considers both operating and financial risk. Okay? It considers both operating and financial risk. Keep writing if you are interested, if you want full marks. It considers both operating and financial risk. Now I'll give you formula. Combined leverage is equal to percentage change in EPS due to, come on, percentage change in sales, or operating leverage into, come on, financial leverage, or What is the formula for operating leverage? Contribution by EBIT and financial leverage EBIT divided by EBIT minus interest minus preference dividend upon 1 minus tax rate. So EBIT will cancel. So you can just write contribution divided by EBIT minus interest minus preference dividend upon 1 minus tax rate. I repeat last formula, contribution upon EBIT minus interest minus preference dividend upon 1 minus tax rate is right. So these are the three types of leverages. Leverages are the study of operating risk, financial risk and total risk. Higher the leverage, higher the risk. Lower the leverage, lower the risk. So investors can take investment decision by looking at the leverages. Write down few more lines. Have you noted up to this? So write down percentage change in EPS equal to percentage change in EPS equal to percentage change in EPS equal to, right below, percentage change in EPS equal to, this they ask you so many times, is percentage change in sales multiplied by combined leverage. Percentage change in sales required will be equal to percentage change in EPS upon combined leverage. Right? Keep writing. Good student will write. Today before you sleep, revise also. Now write down operating leverage equal to combined leverage divided by financial leverage. Highly tested in the exam. Okay. One more write. Financial leverage equal to combined leverage upon, yes, financial leverage is combined leverage upon operating leverage. So sometimes they will give you two ratios, you can find the third one. Is it right? Then write EBT equal to EAT upon 1 minus tax rate. Reverse working question. From EBT, from EAT you have to find EBT. Is it right? So you will be able to do it. One more formula, EPS equal to, in some question you will be asked to find EPS, PAT minus preference dividend upon number of equity shares. Is it right?
Yes, sir.
Say yes or no. Yes. So this was a quick summary of leverages. Now we'll practice important questions. Are you ready? So take out our book and we are going to solve important study material RTP, MTP and exam questions. Okay. So I will solve question number 13, basic question for understanding purpose. Source is May 2018 RTP exam. Calculate the operating leverage, financial leverage and combined leverage. So this is for checking how to apply the formula from the following data under the following situation 1 and 2 and financial plan A and B. Two situation and two financial plans. Installed capacity is 4000. You have to look at this capacity, actual production and sales. Actual production and sales 75%. So 75% means how many units? 75% is actual production of installed capacity. So 75% of 4000, 3000. Selling price 30, variable cost 15, fixed cost situation 1 15,000, situation 2 20,000. Capital structure also have two financial plans, equity and debt. In plan A they are equal 10,000, 10,000. In plan B equity is more, debt is less. And what is the rate of interest on the debt? 20% for calculation purpose. So how many answers would you require? How many answers would you require? 4 answers will be required. There are two financial plan and there are two situations. So 2 into 2, 4 combination will be there. Situation 1 plan A, situation 1 plan B, situation 2 plan A, situation 2 plan B. So we'll solve in one table or 4 tables? One table. Okay, one table. I know, I was just testing you. Calculation of operating leverage, financial leverage and combined leverage. And combined leverage.
How does fixed cost affect the leverages?
How the fixed cost will affect leverages, you will see in this problem. Very good. So you first write down situation 1. Under that write down plan A, plan B. Then write here situation 2, plan A and plan B. Okay. So first point A, write down sales quantity, which will be 75% of 4000. So 3000 in each column. Okay. Point B, sales amount at the rate of rupees. This question they have asked in the exam also in previous years. So sales at rupees 30 per unit. Okay, sales at rupees 30 per unit means multiply 3000 into 30. So that will be 90,000. write down 90,000. Point number C, write down variable cost at the rate of rupees 15 per unit. 15 into 3,000, 45,000, 45,000, 45,000, 45,000. Any query till now?
No, sir.
Point number D. Format is same. Contribution B minus C. So this will be 45,000, 45,000, 45,000, 45,000. So far it is right. So point number E would be operating fixed cost. In situation 1, operating fixed cost you will see in the question center of the question 15, and in situation 2
Sir, it is 20,000.
it is 20,000.
Yes, sir.
Easily understandable.
Yes, sir.
Point number F, write down EBIT D minus E, that is 30,000, 25 again 30,000, 25,000, 25,000. Point number G, write down less interest. In interest in plan A, first column is plan A, interest will be 20% of 10,000. 20% of 10,000, 20% of 10,000, 2,000, and in plan B it is 20% of 5,000. 20% of 5,000, 1,000. In bracket write 20% into 5,000. Same thing repeat, 2,000 and 1,000. Okay. So what will you get now? EBT. First column 28,000, second 29,000, third column 23,000, fourth column 24,000. Is it right? Any query on this basic working?
No, sir.
Then write down point number I, operating leverage. Operating leverage is, what is the formula? Contribution upon EBIT. Contribution is point number D and EBIT is point number F. So D by F, student will take the calculator. D, this is F.
1.5.
So 1.50. Okay.
1.5.
Next one, same 1.5. Next one, 1.8, 1.8. Situation 1, 1.5. Situation 2, 1.8. Point J, write down financial leverage. Financial leverage formula is EBIT divided by EBT, F by H. F by H. F by H. So this is line number H. Try.
Financial leverage.
Just answer in 2 digits. 1.07. Okay. Answer in
1.03.
03. Okay.
1.08.
1.08.
1.08. 09 होगा.
1.04. Last one. 1.08 or 0.9 is okay. You can make it 0.9. Point number K, write down combined leverage. Combined leverage means operating leverage
into financial leverage.
I into J. Just multiply the last
So
two.
1.605.
1.605.
Sir, 1.545.
1.545.
Sir, 1.962.
1.962.
Sir, 1.872.
1.872. Identify which is the highest combined leverage.
Sir, 1.972. Situation 2 planning.
Highest. And which is the lowest.
Sir, situation 1 plan B.
So when is the total risk high? When you are using high fixed cost. Can you see the fixed cost is also high here? Out of the two fixed cost, 20,000 is high. And out of the two, interest 2,000 is high. So when both are combination of high, combined leverage will also be highest. Whereas in plan B and situation 1, interest is also lower of the two and operating fixed cost is also lower of the two. So therefore, if both operating fixed cost and financial fixed cost are on the lower side, combined leverage will also be lower. Combined leverage will also be lower. Do you agree? Say yes, we agree. Sometimes they will ask you in the question, identify highest and the lowest risk. Situation 2, plan A is the highest risk. Situation 1, plan B is the lowest risk. Okay. So if they ask you to identify, you can do that. Dear student, please come to question number 2. This not question number 2. Just go to your November 2022 exam question. One question from November 22 exam we will take. Question number
RTP 33 and
question number 34. The following information is available for SS Limited. Following information is available for SS Limited. Question number 35. Sorry, question number 35. This question is important. It was asked in November 2022 exam for 10 marks. And you will be able to solve. Don't worry. Following information is available for SS Limited. Profit volume ratio is given 30%. Means contribution upon sales is given. Operating leverage is given 2. Financial leverage is given 1.5. Loan is given rupees 1,25,000. Post tax interest is given. Oh my God. Post tax. Underline post tax. Many students made mistake because they took it as an interest rate. It is not interest rate. It is interest net of tax. It is interest net of tax. So I want to ask you, the intelligent student, if tax rate is 30% and post tax interest rate is 5.6%, what will be the interest rate on loan? What will be interest rate on loan? 5.6% is I into 1 minus T is 5.6%. Tax rate is 30%. So interest will be 5.6 divided by 1 minus 0.3. Is it 8%? 8% is the actual interest rate. After deducting tax shield, you get 5.6%. Now you are given market price of the share is 140. Market price is 140 and P ratio is given 10. Market price MPS divided by P ratio. Yes, answer my question. What will you get? One student is saying we will get EPS. You are right. So once you get EPS, you will be able to answer this question. Prepare the profit and loss statement of SS Limited. Profit and loss statement, and then find out the number of equity share. So what is my starting point? I will be able to first find out the interest on loan. Can I find interest on loan? Which will be 8% of 1,25,000. From interest and financial leverage, you can find EBIT. EBIT and operating leverage, you can find contribution. Contribution and profit volume ratio, you can find sales. And then we can prepare one income statement. We will get earning after tax. Earning after tax divided by EPS will give you number of equity share. Is it right? So write down the answer. First you write down which is my starting point, otherwise you can't solve the problem correctly. Pre-tax interest rate is equal to question from November 2022 exam. Pre-tax interest rate is equal to post-tax interest rate upon 1 minus tax rate. Post-tax interest rate upon 1 minus tax rate. Yes, come on, answer. So you have to write everything in detail. 5.6 divided by 1 minus 0.3. So that will give you 8%. That will give you 8%. Then write down next one. Interest on loan. Interest on loan. Loan is 1,25,000 into 8%. 10,000. So now I will use rupees 10,000 interest. I will use financial leverage and find out EBIT. So next heading write down calculation of EBIT. Next heading calculation of EBIT. Calculation of EBIT. So under that you write down equation, write down first financial leverage 1.5 equal to EBIT upon EBIT minus interest 10,000. So you do the cross multiplication. 1.5 EBIT minus 15,000 is equal to EBIT, and then you deduct EBIT from 1.5 EBIT. You will get 0.5 EBIT is equal to 15,000. So my answer is EBIT is how much? One student is saying 30,000. Very good. Amazing. On the screen, check the answer, 30,000. Don't write directly in the exam if it is a 10-mark question. Otherwise, you might lose marks. My job is to instruct you. Your job is to follow. Once you got EBIT, now write down the next heading, calculation of contribution. Calculation of contribution. Which leverage you will use for getting contribution? So write down operating leverage is equal to contribution upon EBIT. Please pay attention, please be alert, and you will understand. Don't take this question lightly, already 10-mark question in the exam. So I will ask you now, give me contribution amount. 2 is equal to C by 30,000. When you solve it, you get 60,000. Contribution is 60,000. Please move ahead. PV ratio is given 30%. PV ratio, profit volume ratio, is equal to 30%. Profit volume ratio is 30%. Contribution is 60,000. So my question to this batch of highly talented students, what will be sales? Sales will be how much? Contribution is 30% of sale. So sales will be 60,000 divided by 30%. Is it 2 lakh rupees? Sales will be 2 lakh. Sales will be 2 lakh. Now you can prepare profit and loss statement. Write down statement of profit and loss. Statement of profit and loss. This is a highly tested question in the exam. Right hand side rupees. Point number A. Point number A, write down sales 2 lakh. Point number A, sales 2 lakh. Now if PV ratio is 30%, what will be variable cost to sales ratio? If PV ratio is 30%, what will be variable cost to sales ratio? 70%. Write down 70%. Otherwise you can write it as a balancing figure by first writing contribution. So write down, please write down, don't talk, contribution 60,000. You can't get a simple question than this. Now please complete yourself and reach earning after tax. Reach earning after tax. Complete the table, reach earning after tax. Done. So we will write first EBIT was how much? 30,000. So fixed cost will be balancing figure 30,000. Or if you want to write, you can write in bracket EBIT minus contribution. So it should be contribution minus EBIT, sorry. Fixed cost is equal to contribution minus EBIT. Do you agree? So what is the next thing? Interest. How much was the interest? 10,000. What will be EBT? 20,000. What is tax at the rate of 30%? Tax at the rate of 30% will be how much? 6,000. So my question was, what is earning after tax? So this is your first answer, 5 marks if you reach up to this point. Okay, 5 or 7 marks you'll get. And there is one more question, how many number of shares are there? So write down below. First I will find EPS, and to find EPS what they have done, they have given you MPS and P ratio. In the ratio analysis chapter, capital structure chapter also, you might have seen EPS is equal to MPS by P ratio. EPS equal to MPS by P ratio. 140 divided by 10. 140 divided by 10. 14 rupees. Shabash. Welcome. Very good. Now what was your earning after tax in the previous table? 14,000. And how much is EPS right now? 14. So can you find out number of equity shares for me? Write down number of equity share equal to EAT upon EPS. Please write EAT upon EPS. EAT is how much? EPS divide 14,000 divided by EPS 14. Answer 1,000. You will get 10 marks. Is it right now? Question number 35 is over. Another highly tested question in the exam, which is very important for your future exams, is question number 17. So I would request all of you to come to another important question for the day. Question number 17. Variety of questions you have to solve. All these questions have come in the past examinations and they can be asked again, and there are different varieties of questions. So are you ready? Yes. Fully ready? Are you with me? Don't go behind, don't go ahead. Okay. Keep question number 17 in front of you from our book. A firm has sales of rupees 75 lakh. Variable cost is 56% and the fixed cost is 6 lakh. So you can find out what is EBIT, what is contribution, etc. It has a debt of rupees 45 lakh at 9% and equity of rupees 55 lakh. You are required to calculate and interpret the firm's return on investment. ROI means return on investment. Does it have a favorable financial leverage? Does it have a favorable financial leverage? Very good question. So when will a firm have favorable financial leverage? When return on capital employed on pre-tax basis is more than rate of interest. So this is called favorable financial leverage. Third question is, if the firm belongs to an industry, so you have to compare with industry also, whose capital turnover is 3, does it have a high or a low capital turnover ratio? So the formula is sales divided by capital employed. Another company or other firms in the industry has a capital turnover of 3 times. We have to compute the capital turnover ratio of this firm. If it is higher, then we will say it has a high capital turnover than the industry. And if the answer is less than 3, we will say it has a lower capital turnover ratio than the industry. Here the capital employed would mean debt of 45 lakh plus equity of 55 lakh. 45 lakh plus 55 lakh, 1 crore. So what is the mistake the student commit here? They only take equity capital 55 lakh. So you will lose 2 marks. Each question has 2 marks weightage. Total weightage on this question when it was asked in the original exam was 12 marks. And you will see there are 6 or 7 parts in this question. So it can be at least for 10 to 12 marks. Next question is bonus mark for you. Operating, financial and combined leverage of the firm. Next question will test your understanding of this chapter. If sale increases by 10%, by what percentage EBIT will increase? I will ask you a question. Please wake up and reply. Which leverage measures the relationship between sale and EBIT? Operating leverage. So if sales changes by 10%, by what percentage EBIT will change? Will be equal to 10 multiplied by operating leverage. 10 multiplied by operating leverage. Formula was given to you some minutes back. At what level of sale? At what level of sale the EBIT of the firm will be equal to 0? Which leverage connects sales with EBIT? EBIT. Please do not answer in a hurry. Already I have given you the theory in detail. Sales and EBIT. Which leverage connects sales with EPS? Okay, forget EBIT. Sales and EPS. Because after EBIT we compute the EPS only. Combined leverage. So first thing is we will use combined leverage here. EBIT of the firm will be equal to 0 means What is the percentage decline in EPS? 100%. Percentage decrease in EPS would be 100%. So 100% divided by combined leverage will give you percentage decrease in sales. Is it right? Your existing sale is 75 lakh. 75 lakh minus percentage decrease in sale, everything will be dictated, don't write. 75 lakh, first understand. Okay, we are not here to mug up the topic. For that there are other classes, okay. Some are very nearby also. Combined leverage measures by what percentage EPS will change if sales changes by 1%. So if I want to know by what percentage sales will change, you have to take change in EPS divided by combined leverage. So this will give me percentage fall. Question is what level of sale? What level of sale means your existing sale minus percentage decrease will give you revised sales at which EBT will be 0. If EBT is 0, EPS will be automatically 0. Okay. Next point. When it comes to applying intelligence, you people go on back foot because our education system has become a rote learning exercise. Okay. If EBIT increases by 20%, by what percentage EBT will increase? One more time. Which ratio links EBIT with EBT?
The financial leverage.
Financial leverage. So if EBIT increases by 20%, by what percentage EBT will increase? 20 multiplied by financial leverage. If you can understand this answer, it means you have understood this topic. Okay, rest is only practice. So start. First I will find out various numbers in profit and loss statement. Okay. So let us start. First we'll write down step 1, statement of profit and loss, because all figures will come from this working only. To answer the different questions, I will require EBIT figure, EBT figure, contribution figure. So that will come from statement of profit and loss. So first I will give you the chance to complete sales less variable cost. You have to complete the table. Contribution less fixed cost, because when you will try you will learn more. EBIT less interest, EBT. Don't go by rote learning, okay? Don't mug up things. This is a financial management subject. You have to understand it. You have to feel it from inside. So I have given you a format and you have to finish it. Time allowed 15 seconds. Okay, time to check the answer. Sales 75 lakh. Variable cost is 56% of sale. 42 lakh. Contribution will be fixed cost. EBIT. Interest 4 lakh 5,000. EBT. Very good. Close. this table. Tax is not given, not required. Now one by one, first question is what is ROI? ROI means return on investment. So write down calculation of return on investment. Now we have two approaches here. One is called long term fund approach, means we will take equity shareholder fund plus debt fund also. How much? And here we calculate what is called ROCE pre-tax. This will help us to check whether financial leverage is favorable or not. And the formula for this is EBIT upon long term capital employed. Long term capital, write down. Long term capital employed, that is equity plus debt. Equity plus debt. Now where is EBIT? Left side. You can see this 27 lakh. Equity is 55 lakh plus debt is 45 lakh. That is 27%. Now you also write ROCE post tax will be equal to ROCE pre-tax into 1 minus tax rate. ROCE pre-tax into 1 minus tax rate. So you can save time. 27 into 1 minus, anybody for tax rate? Wait, there is no tax rate. Okay, tax rate is not given. So you can just delete it. Then write down one more thing, write down. Second approach is, if tax rate was given, then you do it. Okay. Equity shareholder fund approach. Is equal to, so because we don't have tax, so EBT will take divide by equity shareholders funds. Give both answer. We don't know what they want. So answer is 22,95,000 divide by 55 lakh into 100.
41.73%.
Approximately write down 41.72%. Okay, no problem. We are not a science student. Remember, we are a commerce student. Commerce student is happy with 42% return also. Okay. Point. What is this? Are we launching a rocket?
No, sir.
Does it have favorable financial leverage? Test your intelligence. Is the ROCE pre-tax
Yes.
more than the rate of interest the company is paying?
Yes. 3 times.
So it is earning 27% using the borrowed money,
Borrowed.
but paying only an interest rate of 9%. Is it right? So write a note. Note, write down. The firm has favorable financial leverage because ROCE is greater than rate of interest. ROCE is greater than rate of interest. Also, we can see that return on equity is greater than return on capital employed. Return on equity is greater than return on capital employed because the excess return earned over the rate of interest, excess return earned over the rate of interest belongs to equity shareholders. Belongs to equity shareholder. So that was my second question. The firm belongs to industry whose capital turnover is 3. Does it have a high or a low capital turnover ratio? So answer of this part, write down capital turnover ratio. Capital turnover ratio of this firm is equal to sales by capital employed. Sales by capital employed. Sale is how much?
Sir, sale is 75 lakh.
And capital employed is?
Sir, it is 1 crore.
55 lakh plus 45 lakh, 1 crore. We'll take long term, okay? Not just equity but debt also. So that is 0.75. That is 0.75. Note, industry capital turnover ratio is 3. Hence, this firm has lower capital turnover. Hence, this firm has lower capital turnover. So that was my question number 3. Now, next question is very easy. Operating financial and combined leverage. Write down operating leverage formula. Contribution upon EBIT. So tell me how much was the contribution in your first answer?
So it is 33 lakh.
33 lakh.
EBIT
And how much was EBIT?
27 lakh.
27 lakh.
That is 1.22.
1.2222 times. Then financial leverage. Formula.
EBIT minus interest.
So we can write EBIT divided by EBT. EBIT minus interest is EBT. 27 lakh divided by 22 lakh 95,000.
1.18.
1.18 approx.
Yes, sir.
Up to this you have done.
Yes, sir.
One next, write down below that
Combined.
combined leverage. Contribution upon EBT. Contribution is how much?
EBT
33 lakh. Contribution upon EBT. EBT is 22 lakh 95,000.
22 lakh.
Up to 4 digits in decimals.
1.438 approximately.
438.
8.
Or there is a shortcut also. Or operating leverage into financial leverage. How much is operating leverage? 1.2222.
1.222.
And financial leverage was 1.18.
1.439.
So approximately 1.439. Both are okay. Whichever you want to use. That was my question number 4. Right. Question number 5. If sale is increased by 10%, by what percentage EBIT will increase? So write down percentage increase in EBIT is equal to percentage increase in sales multiplied by into operating leverage. Very good. What is percentage increase in sale? 10. Operating leverage 1.2222. 12.2222%. Done. If you know the concept, you can solve easily. Next question is, this is over. At what level of sale, so we have to find sales, EBT of the firm will be equal to 0. So here we are going to apply combined leverage. Okay. So write calculation of revised sales level at which EBT will be 0. Very few students are able to answer this question correctly. So first you write down point number A, percentage decrease in EBT or EPS. If your EBT becomes 0, EPS will be 0. Percentage decrease in EPS will be 100%.
Yes.
Only when the EPS decreases by 100%, it will become 0. Point B, combined leverage 1.439 on the left side, 1.439 you can see. So point number C will be percentage decrease in sales. Percentage decrease in sales, A by B. So that is 100 divided by 1.439. Write in 4 digits, 69.4927%. So sales, if declines by 69.4927%, your EPS will decline by 100%. Question is not percentage, question is revised sales amount. So point number D, revised sales amount. What is your existing sales? 75 lakh minus 69.4927%. So write 22,92,000 approximately. Whatever you get, write approximately in bracket. Because of rounded off,
22,880.
yes, 22,90,000 you can write. Because of rounding off, there is a difference. Whatever you are getting, write down bracket approximately, write down. Okay. Because all these numbers that we have used are rounded off in 2, 3, 4 digits. So, and the amount is huge, 75 lakh. So you get a difference of few hundred to few thousand rupees here. Anyway, last question. If EBIT increases by 20%, by what percentage EBT will increase? So write down last answer. Percentage increase in EBT is equal to percentage increase in EBIT multiplied by which leverage? Financial leverage. These are some basic questions which they always repeat in the exam. So that they have given is 20 and this is 1.18, 23.6% approximately. Okay. This wonderful question is over. Now one more different type of question they have asked in the exam, and that is question number 18. This question, write down in bracket past exam question also. It was seen in November 2019 RTP, but this question has been asked in earlier exams also, and they are going to repeat it again. Question is again different from the previous problems that we have solved. The following summarizes the percentage change in operating income. Percentage change in operating income means percentage change in EBIT. So this is percentage change in EBIT column. This column is percentage change in sales column. So tell me which ratio deals with percentage change in sale and percentage change in EBIT. Come on. Sales and EBIT, operating leverage. And what is the formula for operating leverage when you are given percentage change in EBIT and percentage change in sale? Percentage change in EBIT upon percentage change in sale. So if you know that, then you see a bonus mark, 2 marks bonus. This time they have given you one more concept called beta. So beta is a measurement of risk. Beta is a measurement of risk. Higher the risk, higher the beta. Higher the risk, higher the beta. Okay. In one earlier chapter, those who have studied cost of capital chapter, this term beta was used in calculating cost of equity, CAPM formula. Cost of
Beta into RM minus
equity under CAPM is RF plus beta into RM minus RN. Okay. Revision of revision. So there are 4 firms: ABCD, change in revenue, change in EBIT and beta. First question, compute degree of operating leverage. For each firm, comment also. So in comment what you have to do, which firm is more risky, which firm is less risky. And then use the operating leverage to explain why these firms have different beta. Why these firms have different beta? Why these 4 firms have different level of beta? So let us first write down in the notebook calculation of operating leverage. For this question, the formula to be used will be change in EBIT upon change in sale. Okay, if you try to apply contribution upon EBIT, you will not be successful. So write down 3 columns: firm, calculation. Under calculation, write down percentage change in EBIT upon percentage change in sales, and the last column operating leverage. Presentation is an art that gives you some extra marks. So make tables wherever possible, write calculations every time. So first keep one line blank and write down A limited, B limited, C limited, D limited. For A limited, percentage change in operating income is 22 and divide by 35. Divide by 35. So how much is the answer? 0.63. Don't multiply by 100. 0.63 times. Operating leverage is written in time, so we don't multiply by 100. Okay, next one. Try little fast now.
Okay.
35 divided by 24. 1 point something.
1.46.
Okay, 2 digits are enough. 26 divided by 29.
0.89.
0.89. Then last one, 30 divided by 32.
0.92. 94.
0.94. The answer is not over. Below that you have to write comment also. This is highest, B, and I think A is lowest. Lowest. So write down comment. I'll dictate. Write down. Everybody ready? Write comment dash. B has the highest operating risk. B limited has the highest operating risk. B limited has the highest operating risk. Whereas A limited has lowest operating risk. A limited has lowest operating risk. A limited has lowest operating risk. Then write down next line. Tutorial note. Tutorial note. Tutorial note in bracket not for exam. Tutorial note in bracket not for exam. The question seems to be wrongly drafted. The question seems to be wrongly drafted because operating leverage cannot be between 0 and 1. Operating leverage cannot be between 0 and 1. But in the given question, the operating leverage of A limited, C limited and D limited, operating leverages of A limited, C limited and D limited are between 0 and 1. Are between 0 and 1. So institute, they have just given some random figure in the question.
Just to calculate.
just for calculation, but intelligence is missing there because it can't be between 0 and 1. Between 0 and 1 means your EBIT is higher than contribution, which is not possible because contribution minus operating fixed cost is EBIT. So if I apply the formula contribution upon EBIT, it can't be below 1, between 0 and 1. Okay, so anyway, so we have written the comment. Now the next question was why these firms have different beta. So write down one small note for that. Answer of part 2. Beta is a measurement of risk. Beta is a measurement of risk. Beta is a measurement of risk. Operating leverage measures business risk. Operating leverage measures business risk. Higher the operating leverage, higher the operating leverage, higher the business risk, higher the operating leverage, higher the business risk, and higher the beta. Higher the operating leverage, higher the business risk, and higher the beta. We can see that, next line, we can see that beta of B limited is highest. We can see that beta of B limited is highest because its operating leverage, is highest, is right. Also beta of A limited is lowest. Also beta of A limited is lowest because its operating leverage is also lowest, because its operating leverage is also lowest. Okay, so there is a direct relationship between operating leverage and beta. Okay, other things remaining constant because there are other factors also which can affect the calculation of beta. Actually, beta is not a part of your syllabus in detail. Okay, any query now? No query. Next question, try classwork. Question number 20 for classwork. Please try yourself. I'll just come in 2 minutes. Okay, let us try together. Prepare income statement of A and B. Financial leverage is given, interest is given. So using these two, you can find EBIT. EBIT and operating leverage you can use and find contribution. Contribution and this variable cost to sale you can use and find sales figure. And therefore you can prepare your income statement. Is it right? So first you write down. If you have done, check it. If you have not done, do it now. First step 1 will be calculation of EBIT. Calculation of EBIT. A limited, B limited. Financial leverage is equal to, the formula is financial leverage equal to EBIT upon EBIT minus interest. For the first firm, financial leverage is how much? For the first firm A, financial leverage is how much? 3:1. So 3 is equal to EBIT upon EBIT minus interest is how much? 20,000. Anybody who has computed the EBIT of A limited? So one student is saying 30,000. Next column 4 is equal to EBIT upon EBIT minus interest of second firm is 30,000. Anybody who got the answer? EBIT equal to 40,000. 30 and 40. Step 2. Calculation of contribution. Now we have EBIT, we have operating leverage. Can we compute contribution?
Yes, sir.
Operating leverage is contribution divided by EBIT. Operating leverage is 4. equal to contribution upon 30,000. So contribution of A Limited is how much? Second form is 5 is equal to contribution upon 40,000. So contribution is 2 lakh. I think you must have done up to this. Yes, this was also an exam question some years back. Step number 3, write down calculation of sales. Right hand side, 2 columns, A Limited, B Limited. First point A, contribution. Contribution from step number 2. In bracket step number 2, write nicely. One day you have to revise also. 1,20,000 and 2 lakh. Point number B, variable cost to sales ratio is how much? 66 2 by 3% and 75%. Wait. So can I say contribution to sales ratio? If variable cost is 66 2/3%,
minus 100 minus that.
so contribution to sales ratio will be 100 minus point number B.
33.333%.
Very good. 33 1 by 3%, and this will be 25%. Point number D, sales. This way write nicely, A divided by C. 1,20,000 divided by 33 1/3%.
3,60,000.
3,60,000. Next one, 8 lakh. So now we have got all the missing data. We can find out some more missing data in the table directly. Okay. Are you ready?
Yes, sir.
So write down income statement. Right hand side, 2 columns. A, B. First write down point number A, sales. How much sales you have computed? 3,60,000 and 8 lakh. Very good. Okay, so reply fast because most of you have already done. Less variable cost, 66 2/3%, 2,40,000, 6 lakh. Contribution we have computed 1,20,000 and 2 lakh. Wait, point number D, less fixed cost.
EBIT balancing figure.
You can say balancing figure. And point E, write down EBIT, which we have computed. How much was that? 30, 40. So tell me, fixed cost balancing figure is how much? 90,000 and 1,60,000. So what is point number F? You will write less interest, which is given. How much? 20,000 and very good. Point number next. EBT 10,000, 10,000. Tax at the rate of 45%. 4,500. 4,500. Therefore, earning after tax 5,500. 5,500. For this much effort, you will get 4, 5, 6, 7 up to 10 marks. Okay. Done. Any query on this? Similar questions are asked in the exam with different figures. Now come to question number 11. This is another way of asking a question. Question number 11. Okay. Betatronics Limited. Which company? Betatronics has the following balance sheet and income statement information. So this time they have given you a full balance sheet Share capital 10% debt, retained earning, current liabilities, fixed asset, current asset. Income statement, sale, operating expense, underline including 60,000 depreciation. Doesn't matter. EBIT, directly EBIT. Less interest, EBT, tax, earning after tax. So in this question, they have not given contribution. Let us read and see can we get it. Determine the degree of operating, financial and combined leverage at the current sales level if all operating expenses other than depreciation are. So here you see this is 120
So
minus 60 depreciation. So 60,000 is variable cost. Contribution will be 280. Just unnecessary torture to the student, okay? But some student will become a repeat customer of the institute because of this. If the total asset remain at the same level, but sales increase by 20% and second decrease by 20%, compute the EPS at the
combined leverage.
new sales level.
Combined leverage.
So we can find out by applying the combined leverage formula. Percentage change in sale and change in EPS, these two variables are connected by a leverage called combined leverage. So 20% multiplied by combined leverage will give you percentage change in EPS, and then you can find out the new EPS level. Is it right? Say yes.
Yes, sir.
Louder.
Yes, sir.
That's better. So write down. First question is compute the degree of operating, financial and combined leverage.
Sir, financial degree.
Degree of operating, financial and combined leverage one by one. First you write down calculation of operating leverage. What is the formula for operating leverage?
The contribution upon EBIT.
Contribution upon EBIT. But contribution is not given directly. Sales is given
Yes, sir.
3,40,000 and variable cost is 1,20,000 is the total operating expense minus 60,000 depreciation. Minus 60,000 depreciation. This is depreciation. And that you divide by EBIT, which is given 2,20,000. So answer in times 1.2727 times. Second, write down calculation of financial leverage. Formula, anybody formula?
EBIT upon EBIT minus interest.
EBIT upon EBIT minus interest. Or you can write EBT because in the question EBT is given to you. So no need to do any extra work. EBIT is 2,20,000 and EBT is 1,60,000. Can you please reply? 1 point how much?
1.375.
375. Okay, wait. Combined leverage. We'll multiply the two answers is equal to operating leverage into financial leverage. Operating leverage 1.2727.
1.75.
Financial leverage 1.375. Kindly reply.
So 1.75.
So 1.75 approximately. I will require this number in subsequent calculation. Okay, 1.75. So this is your first question. Compute the three leverages already done. if total asset remain at the same level, sales increase by 20% or decrease by 20%, compute the EPS at the new sales level. So we write down answer for new EPS level if sales first decrease by 20%. First point A, write down percentage decrease in sales 20%. Combined leverage, how much is combined leverage? 1.75. So can I find out percentage change in EPS? Sales versus EPS is linked through combined leverage. Okay, dear student, please reply. 20 into 1.75, A into B, is it 35%? Point number D, do we have any tax in this problem? Yes, first I have to find current EPS, which we have not done actually. Current EPS is 1,04,000 is the earning after tax, and the number of share in the balance sheet is 80,000. 8 lakh divided by 10. 8 lakh divided by 10, 80,000. So can you guess what is your current level of EPS? Is it 1.3? So point number E, write down new EPS. Revised EPS is 1.30 minus 35%. 0.85 approximately. Answer is not over. Why? They have also asked you if sales increase by 20%. Write down last step. New EPS if sales increase by 20%. Okay, right hand side amount. First point A, percentage increase in sales 20%. Point B, combined leverage. Combined leverage is how much? It's given in the problem, both increase and decrease. Point C, percentage increase in EPS A into B, 35%. And point D, new EPS or revised EPS, new or revised. So existing EPS was how much?
1.3.
On the screen below, 1.30. So 1.30 plus 35%.
1.75.
So 1.76 approximately right now. Is it right? This way you can do using the knowledge of leverage. Otherwise you can prepare the full table. You can prepare profit and loss statement. Sales is 3,40,000. You can make one column less by reducing by 20%, one column by increasing by 20%. Accordingly, you have to compute variable cost, depreciation, fixed cost, interest. So that will take little more time. Preparing a full income statement will take more time. If you have idea of leverage, you can do it faster. So that was a very important question number 11. Now we'll come to question number 12. A company had the following balance sheet on 31st March 2021, rupees in crore. Share capital 50 lakh, share of rupees 10 is reserve and surplus 15% debenture 10 crore. So how much is the interest?
10 crore,
10 into 15%.
1.5 CR.
1.5 CR is the interest. If required, you will use it. Current liability, fixed asset, current asset. They are not required. Additional information, fixed cost per annum excluding interest, means operating fixed cost. 4.
4 crore.
Then variable operating cost ratio. Variable operating cost ratio means variable cost to sales. Variable cost to sales is 65%. And total asset turnover ratio is 2.5. On the screen, asset is 20. Asset turnover ratio is 2.5. So sales will be how much? Anybody?
20 divided by 2.5. 8 crore.
Sales will be how much?
उल्टा होता है.
Sales divided by assets is called asset turnover ratio.
20 into 2.5. 50 crore.
So sales will be equal to asset turnover ratio 2.5 into 20, 50 crore. And once you get the sales figure, you will get variable cost here. If you get variable cost, you get contribution. Contribution minus fixed operating cost. You will get EBIT. Here it is interest. 1.5 crore. You will get EBT minus tax. You will get EAT. And then you can compute the EPS, operating leverage, financial leverage, and combined leverage. What a simple question. Is it right? This question is in the study material. RTP May 19, July 21 exam for 10 marks. So we have covered in one question exam, RTP and study material. So first write down step 1. Calculation of sales. You have to know the formula of asset turnover ratio to solve this question, which is covered in ratio analysis topic. The formula for asset turnover ratio, because student what they do, they take asset upon turnover. Don't go by the name. It is sales upon assets. It should be average asset, but average cannot be calculated. So it's okay. This is 2.5 divide equal to sales upon total of the asset side is 20 crore. Therefore, sales equal to rupees 50 crores. Any query up to this?
No, sir.
Why no?
Because
We have understood.
yes, sir.
Have you understood?
Yes, sir.
Okay. The question is calculate the following and comment also. So some comment also we will write at the end. Next heading write down calculation of first question EPS, comma, second question operating leverage, comma, third question financial leverage, and fourth question combined. Always write a nice heading. Okay. So therefore, we'll prepare a small table first. Start with which number? Sales. So sale in rupees in crore, write down at the top. At the top right hand corner, rupees in crore. What is the sales we have computed?
50 crore.
50. Less. What is the variable cost to sales ratio in the problem?
Variable cost to sales ratio is
65% into 50 crore.
50 into 60.
That is
32.5.
very good. Point number C.
70.5.
Contribution.
A minus B.
A minus B.
17.5.
Then point D, less operating fixed cost, which is given in the problem. How much?
Sir, it is 4 crore.
4. Point E, EBIT, speed, increase the speed now. The purpose of practice is to increase the speed. Less interest, go to balance sheet. 15 crore into 15% into 10 crore. So interest you are paying is 1.5 crore. Then you write down EBT
EBT is 12.
is 12. E minus F. Then write down less tax at the rate 30%. 3.60. Correct? Easy question.
3.6.
Earning after tax 8.4. Number of equity shares
8.4. Number of equity shares. 5 lakh.
go to balance sheet and search. Number of equity shares are 50 lakh.
50 lakh. Given.
So 0.5 crore in crores write down. In crores. So it is 50 lakh, which means 0.5 crore.
16.8.
So can you tell me point number next K EPS in rupees? I upon J.
16.8.
Is it rupees 16.8?
Yes, sir.
Then write down operating leverage.
16.8 rupees.
Operating leverage will be point number C divided by point number E. Contribution upon EBIT.
Operating leverage.
17.5 divided by 13.5.
Contribution of
1.296 times. Very good. Now come to next, financial leverage.
LM. E divided by G.
So what is the formula you'll use? E divided by
G.
G. Answer
1.125.
1.125. What is the next formula?
MM.
Combined leverage. Just multiply L into M. 1.458.
L into M.
Right. Comment. Comment write down. I'll dictate write down. Okay. Operating leverage measures operating risk, because there is nothing to compare in this problem. Financial leverage measures financial risk. Financial leverage measures financial risk. Combined leverage measures operating and financial risk. Combined leverage measures operating and financial risk. It measures the impact of change in EPS. It measures the impact of change in EPS due to change in sales. It measures the impact of change in EPS due to change in sales. Okay. So this is the comment for this question. Now we'll take a break. Hello students. Today we'll take a quick revision of capital budgeting topic. Okay. And then we'll take some important questions, different varieties of question on this topic. This will seriously help you with the exam. Okay. So first you write down some important points relating to capital budgeting or investment decision topic. Capital budgeting or investment decision. So first you write down capital budgeting techniques. Capital budgeting techniques. Under that we have two types of techniques: non-discounting technique, non-discounting technique. Under non-discounting technique we have payback period. So what is non-discounting technique? Time value of money is ignored. Time value of money is ignored. Payback period. Payback period means time required to recover initial investment. Time required to recover initial investment. Under this write down, if cash flows are even, cash flows are even means same in all the year, then payback period will be equal to initial investment divided by annual cash flow. Initial investment divided by annual cash flow. If cash flows are uneven, then solve by calculating cumulative cash flow. Solve by calculating cumulative cash flow. So you will make table like this: year, cash flow and cumulative cash flow. Okay. So you will write year, you will write cash flows, you will write cumulative cash flow, and then you will see in which year you are able to recover your initial investment. In which year you are able to recover your initial investment. Is it right? Otherwise, initial investment can be recovered between 2 years also, right? So then you will find out the proportion, okay? We will solve one question after some time, you will see the calculation. Second, point number B, write down average rate of return. So right now you underline non-discounting technique. Under that we have payback period, average rate of return, also called accounting rate of return, or in short we will write ARR. Is it right? And how do you compute ARR? ARR is equal to average profit divided by original investment or average profit divided by average investment into 100. So this will give you rate of return in percentage. Okay. Now write down below, average investment is equal to initial investment, half of initial investment minus salvage value plus salvage value and plus additional working capital. Write in good handwriting. One day before the exam, read this. Is it right? So how do you take decision? Decision rule. Decision rule. Decision rule for independent projects. For independent projects, if ARR is greater than cutoff rate means target rate, desired rate, accept the proposal. Okay, and then you write down second bullet point for mutually exclusive projects. Mutually exclusive projects means either of the two can be selected. Okay, one of the two, select project with higher ARR. Select project with higher ARR. One more thing I forgot to write in payback period. Write down in payback period, if you have the space, decision rule. Decision rule, select the project if payback period is lower than cutoff period. Select the project if payback period is lower than cutoff period. Understood? And one more point, if you have space, otherwise write somewhere later. In case of mutually exclusive projects, I'll dictate, write down, in case of mutually exclusive projects, select the option with lower payback period. Select the option with lower payback period. Select the option with lower payback period. Okay. In accounting rate of return, you written decision rule. Write one important note. This is the only method which uses profit for evaluation instead of cash flows. This is the only method which uses profit for evaluation instead of cash flows. So what is the special feature of this method? It uses profit for evaluation instead of cash flows. Now we have written here point number 1, non-discounting technique. Under that, next point 2, write down discounting techniques. Discounting techniques. Why they are called discounting technique? They use time value of money. They use time value of money. Hence, they are called discounting technique. Now, under that, one by one, we'll discuss. A, write down discounted payback period. Discounted payback period. Same as payback period. Same as payback period. However, cash flows are discounted to their present value. Cash flows are discounted to their present value, and then cumulative discounted cash flows are calculated, and then cumulative discounted cash flows are calculated. Then cumulative discounted cash flows are calculated. So what will be the format here? For discounted payback period, the format will be year, cash flow, present value of cash flow, and then cumulative discounted cash flow, and then cumulative discounted cash flow. So one extra step you have to perform, PV of cash flow. Okay. So this way you will draw the format for discounted payback period. Cash flows will be given to you. First convert at cost of capital, PV of cash flow, then compute cumulative cash flow, and then find out between which 2 years you are going to recover your initial investment, and then find out the discounted payback period. What about the decision rule? Decision rule, same as payback period. Decision rule, same as payback period. That means it should be below the cutoff period. If we are evaluating independent project, and between 2 or more mutually exclusive project, we will select that project which has a lower discounted payback period. So now write down point number B, net present value method. Net present value method is the most important method, which is called NPV method. NPV is equal to PV of cash inflows minus PV of cash outflows. PV of cash outflows. And what is the, write down little fast, it is in your interest only. Decision rule. If then NPV is positive accept, NPV is negative reject, NPV is equal to 0 indifferent. So decision rule for independent projects. Is it right? And below that write down point between two or more between two or more mutually exclusive proposals, two or more mutually exclusive proposals, select the option with higher positive NPV. It should be positive NPV and it should be higher positive NPV. If both of them have negative NPV, then both should be rejected. Okay. So we have to first ensure the project we are selecting has positive NPV and we are comparing two or more, then it should have a higher positive NPV. Okay. Now write down point number C, profitability index. Profitability index method, also called, please write down fast, desirability factor. Desirability factor. So here the formula is profitability index equal to PV of cash inflows upon PV of cash outflows. PV of cash inflows upon PV of cash outflows. So what is the decision rule for, it's a ratio, okay? Decision rule for independent projects. So under that write, if profitability index is greater than 1, then accept. Keep writing, keep understanding. If profitability index is less than 1, then reject. If profitability index is equal to 1, then it is an indifferent situation. So profitability index and net present value method give you same conclusion for independent projects. Am I right? Because if profitability index is greater than 1, it is same as NPV greater than 0. Less than 1 is same as NPV less than 0. And equal to 1 is same as NPV equal to 0. So when you are evaluating one single project, either use profitability index method or you use NPV method, you will get the same answer. Is it right? For mutually exclusive proposals, mutually exclusive means you are making a choice. When you have to make a choice between two or more proposal, select option with higher profitability index. Select option with higher profitability index. Select option with higher profitability index. In case of capital rationing situation, in case of capital rationing situation, capital rationing means resources are limited. So when you have limited resources, you will go with the option which has highest profitability index. Highest profitability index brings more inflow for every 1 rupee invested. But one more note, write down. Note, if there is no resource constraint, then select the option with higher NPV. If there is no resource constraint, then select the option with higher NPV, because higher NPV helps in wealth maximization. So when there is no limitation on fund, then why not to put money which gives me more surplus, more wealth maximization. Okay. So this is about profitability index. Any query? Point number D, write down internal rate of return. IRR, popularly called IRR. So it is that rate of discount at which PV of cash inflows is equal to PV of cash outflows. It is that rate of discount at which PV of cash inflows is equal to PV of cash outflows. You can say it is that rate of discount at which NPV is equal to 0. It is that rate of discount at which NPV is equal to 0. Now the formula for calculating IRR is, one is you will use this interpolation method, lower discount rate plus NPV at lower discount rate upon NPV at lower discount rate minus NPV at higher discount rate into the difference between higher discount rate minus lower discount rate. Is it right? Or there is a shortcut formula also if you want to use that. Lower rate plus present value at lower rate, present value, not net present value, present value at lower rate minus initial investment upon present value at lower rate minus present value at higher rate into difference between higher rate and lower discount rate. Okay. So what do you mean by lower rate, higher rate? So you have to make a guesswork about what can be the discount rate at which NP will be 0. So this method requires some trial and error. Lower rate means I have to make a selection of first a rate. If I get a positive NPV, I increase the rate. If I get a negative NPV, I decrease the rate. So the lower of the two rate chosen will be lower rate and the higher of the two rate chosen will be higher rate. Okay. And then you will get the IRR. Now what is the decision rule for independent projects? Write nicely. Decision rule for independent projects. Under that you write down if IRR is greater than cutoff rate. Cutoff rate means desired rate of return. Then accept. If IRR is less than cutoff rate, keep writing nicely. Later on, you can revise it one day before the exam. Reject. And then if IRR is equal to 0, IRR is equal to cutoff rate, then indifferent. Okay. So this is how you will take decision using IRR. Now write down, in case of mutually exclusive projects, select the option with higher NPV. Underline, with higher NPV, because it helps in wealth maximization. Because it helps in wealth maximization. Because it helps in wealth maximization. Now write down point number E, modified IRR. Modified IRR. IRR method has two limitations. Which are these two limitations of IRR method? One is reinvestment assumption. That means IRR method assumes that cash flows are reinvested at the same IRR. And second problem is multiple IRRs. In some situation you can have multiple IRRs, especially when there are many outflows in the project. You can get more than one IRR. So the purpose of calculating modified IRR, removes these limitations. Okay. Modified IRR removes these limitations. So what we do in modified IRR? Steps: 1. Reinvest cash flows other than initial investment. Don't reinvest initial investment, but in year 1, 2, 3, 4, 5 whatever cash flow you will get, reinvest cash flows at a more appropriate investment rate or cost of capital, or if the rate is given, use that rate, or you can invest at cost of capital. And then step number 2, calculate terminal value, that is total value at the end of project life, total value at the end of project life. 3, third, write down, find that discount rate at which PV of terminal value in bracket step 2 will be equal to initial investment, right? So how do you compute it? So that is R is equal to, let us call it R, is terminal value divided by initial investment, to the power 1 by n minus 1. N means number of years. Terminal value means the last year total value you will get. So this is how you will compute modified IRR. Done. Write down below decision rule. Write down same as IRR. Decision rule same as IRR. Any query till now? No query. We'll solve few questions and then you'll understand better. Done. Up to this point number capital B, write down special situations. Write down 1, capital rationing. Capital rationing means, what is capital rationing? Availability of funds is less than requirement of funds. Availability is less than requirement of fund. Everybody is going through capital rationing in his life, yes or no? Even Mukesh Ambani has got capital rationing. Availability of fund is less than requirement of funds. Therefore, limited funds have to be utilized in such a manner, write down nicely, limited funds will be utilized in such a manner that total NPV is maximized. Total NPV should be maximized. Okay. Now write down under that There are two types of projects. Keep writing in good handwriting. Any doubt, ask me. There are two types of projects. Which are these two types of projects? A. Divisible projects. Divisible projects means projects can be accepted in parts. Okay, in parts or proportion. Cost of projects can be accepted in parts or proportion. So how do you take a decision here? How to select projects? How to select projects if it is divisible project? Okay, so first you calculate profitability index. Profitability index will help you to identify which project is best. Okay, then next best. Step number 2, rank the projects. Rank the projects on the basis of profitability index. Rank the projects on the basis of profitability index. Project with highest profitability is ranked 1. Project with highest profitability index will be ranked 1. Then write down, select the project on the basis of rank till the funds are fully utilized. Till the funds are fully utilized. Till the funds are fully utilized. So first you will select rank 1, select rank 2, rank 3 till your funds are fully utilized. Okay. Any query on this now? So this is you will do for divisible projects. Okay. And then you write down next point, B, indivisible projects. Indivisible projects. What are indivisible projects? These cannot be accepted in parts. This cannot be accepted in parts. Either you accept it in full or reject in full. Accept in full or reject in full. For example, a machine, a car. You can't buy 50% of the car if you have 50% of the funds with you. Okay. So how to select projects? How to select projects? Keep writing. I am asking you to write and you are watching. Right. One day before exam, 5 to 10 minutes. This is how the notes should be prepared. Okay. How to select project? First you write down, calculate NPV of each project. First you have to calculate NPV. If it is given, well and good. Not given, then first compute NPV of each project. Okay. Then point number 2, select or make various combinations. Make various combinations. Make various combinations. Make various combinations of different projects within the overall availability of funds. Within the overall availability of funds. So suppose if you have 1,20,000, then you make combination of different projects where total requirement will not exceed 1,20,000. So that is called make various combination. And third step, select that combination which has highest, fill in the blanks, which has highest dash. Select that combination which has highest what? Select that combination which has highest NPV. Select that combination which has highest NPV. So after making combination, select that combination which have highest NPV. Is it right? Then write a note here. Do not consider projects which have negative NPV. If a project has a negative NPV, it will be simply rejected. It won't be considered in any combination. Negative NPV will not be considered in any combination, because if you include negative NPV, your total will fall. So do not include negative NPV projects. Simply reject them fully. Okay, they will not be considered. So this is how you solve the problem of indivisible projects. So we are doing special situations. Under that, first is capital rationing. Second, write down. Second is projects with unequal lives. Projects with unequal lives means when you are comparing two projects, which have different lives. Okay. So we have two methods to solve projects with unequal life, because we have to make them comparable. So one method is called replacement chain method. Replacement chain method. Replacement chain method. So under replacement chain method, what we will do? We will compare on the basis of same number of years. We will compare on the basis of same number of years. For example, write down example. If project A has life of 5 years, project A has life of 5 years, and project B has life of, and project B has life of 10 years. we will repeat project A how many times to make them comparable? 5 year, 10 year. So we will repeat project A 2 times. Very good.
LCM of both of them.
Okay. We will repeat project A 2 times. So you have to take LCM of both the numbers. So you will find a common life. Calculate NPV on the basis of common life. Okay.
If it is 3 and 5, then 15.
If it is 3 and 5, then 15 years we have to take. 3 and 5, 15 years. Project A will be repeated 5 times. Project B will be repeated 3 times. So normally they don't give such questions. It takes a lot of time to solve. So replacement chain method, we will have to compare them on the basis of common life. If required, repeat one or both projects. Okay. And then decision. Decision rule will be select the option with higher NPV, because now they are comparable. Select the option with higher NPV. This is called replacement chain method. This method will become very time consuming if the number of years are like 7 and 11. 77 year you have to is the common life. So normally they don't give you. They are also human beings. You are also hopefully human being. And what is method 2 here for projects with unequal life, which is what we will use, is called equivalent annualized method. Equivalent annualized method. So we'll find out equivalent cash flow. We'll find out equivalent cash flow for all the cash flows given in the problem. Is it right? How do you compute it? So write down equivalent. Please write and please revise. Teacher can only take you up to this point. Okay. Then beyond this point, it is your hard work. Equivalent annualized value is equal to NPV divided by PV annuity factor. NPV divided by PV annuity factor for a given number of years and rate of discount and number of years. So calculate equivalent annualized benefit for all the projects which have different life. And how do you take a decision? Using this method, decision rule. Decision rule A, if the objective is benefit maximization, we want to maximize benefit, then select the option with higher what? Fill in the blanks. Equivalent annualized benefit, EAB, equivalent annualized benefit. And B, if the objective is cost minimization, select the option with lowest EAC. Select the option with lowest EAC. Okay, what is EAC? Equivalent annualized cost. So sometimes the two projects we are comparing are having only cost, like whether I need to buy Activa or I need to buy Pulsar bike. Okay, so I am not going to generate any revenue from them, but I can certainly reduce my cost. So EAC or EAB gives you equivalent annual cash flow. So if it is inflow, you will try to maximize. If it is outflow, outflow, you will try to minimize. That is common sense. So this is called equivalent annualized method. Up to this you have written. The special case number 3. Special case 3. Replacement decisions. Replacement decision. What is replacement? It means selling old asset and buying a new asset. That is called replacement decision. Okay. So the issue is whether to continue with the old asset, whether to continue with the old asset. The issue is whether to continue with the old asset or replace it by the new asset. Understood the issue involved? So under that you write down situation 1. Situation 1, what is situation 1? If the remaining life of old asset, situation 1, if the remaining life of old asset and life of new asset are equal. If remaining life of old asset and the life of new asset are equal, then calculate incremental NPV. So we'll apply which method? Incremental NPV. Then calculate incremental NPV. If incremental NPV is positive, then replace old asset by the new one. If the incremental NPV is positive, then replace the old asset by the new one. And what is situation 2? Situation 2 is if the remaining life of old asset, and life of new asset are different. Possible, because old asset must have already completed certain number of years. New asset may have a longer life. Then how do you compare them? If the remaining life of old asset and the life of new asset are different, then calculate equivalent annualized value for both old as well as new asset. Then calculate equivalent annualized value for both old as well as new asset. Understood? then how do you take a decision? How do you take a decision in situation number 2? After computing equivalent annualized value, how will you take a decision? Already explained to you. In case of equivalent annualized value method, the decision rule is, if you want to maximize benefit, go with higher EAB. If you want to minimize cost, go with lowest EAC. Is it right? So the decision rule will be same as equivalent annualized method. Equivalent annualized method discussed above. Discussed above in point number 2. Discussed above in point number 2. Same as equivalent annualized method discussed above in point number 2. So these are special situations. So this is your syllabus, okay, for capital budgeting chapter, which I have summarized in 3 to 4 pages. How many pages did you write? 6 or 7 pages. So that much is enough one day before the exam. Okay, you want to write more or you want to solve problem? So write one note and then we will solve problems. Note, write down. Note on depreciation. First is note on depreciation. So under that write down, depreciation is a non-cash expense. Depreciation is a non-cash expense. True or false? But tax shield on depreciation is cash inflow. But tax shield on depreciation is cash inflow. If there is no taxation, next note is, if there is no taxation, there is no need to calculate depreciation. There is no need to calculate depreciation. There is no need to calculate, or depreciation is irrelevant. So don't calculate only. Next point, write down, depreciation will be calculated. Depreciation will be calculated as per what? Companies Act or Income Tax Act? As per income tax laws. Income tax laws. Depreciation, suppose in some question they will give you 2 rates of depreciation, one as per books of account and one as per income tax law. We will take as per income tax law. So depreciation will be calculated as per income tax law. Okay. Then next write down, block of asset concept is followed. Block of asset concept is followed while calculating depreciation. Block of asset concept is followed while calculating depreciation. Block of asset concept is followed while calculating depreciation. Next note, write down, note on accrual versus cash basis. Note on accrual versus cash basis. Note on accrual versus cash basis. So under that 2 point, profit will be calculated on accrual basis. Profit will be calculated on accrual basis. Note number 2 below that. However, CFAT will be calculated. Come on, CFAT will be calculated on cash basis, means actual timing of receipt or payment of cash. Because it happens, the question may give you that sales will be collected in the next year. Sales will be collected in the next year. So while calculating profit for income tax purpose, I will take sale in the same year. But while calculating CFAT, I will take sales in the next year. Okay. So in right here refer May 2022 question which we will discuss, that was based on this concept of cash versus accrual basis. Okay, so they can ask question from any corner. So most of the important points I have explained to you, and now some more learning will take place with the help of some important questions. So requesting you to keep the financial management book in front of you so that it will be easier for you to understand what we are discussing in the classroom. Okay, and we will practice all these questions in the notebook. So first we will start with a revision of payback, NPV and IRR. Kindly come to question number 22. Have you reached question number 22? This will help us to revise three concepts: payback, NPV and IRR. Okay, so come to question number 22. This question is there in your study material plus October 19 MTP for 7 marks. Question is, Hind Liver Company is considering a new product line to supplement its range of products. It is anticipated that the new product line will involve cash investment of rupees 7 lakh at the time 0 and rupees 10 lakh in year 1. So investment will be made on two dates, year 0 and year 1. Timing of cash flow is important in this chapter. So the 10 lakh rupees will be discounted by 1 year present value factor. Okay. After tax cash flow of 2,50,000 are expected in year 2, 3 lakh in year 3, 3,50,000 in year 4 and 4 lakh each year thereafter through year 10. Now what do you mean by this line? 4 lakh each year, underline each year, thereafter through year 10. What does that mean? It means 4 to 10 years. Each year 4, 5, 6, 7, 8, 9, 10. The cash flow after tax will be 4 lakh rupees. Is it right? 5 to 10, not 4 to 10. 5 to 10, because year 4 is 3,50,000. Although the product line might be viable after year 10, the company prefers to be conservative and all calculation at that time, which means we will take calculation up to 10 years only. Okay, maybe after 10 years they might get some cash flow, but the company says let us only assume that the product will have a life of up to 10 years only. If the required rate of return is 15%, means discount rate, desired return, target return, find out NPV, is it acceptable? So you will say it is acceptable when NPV is positive. Very easy. All data that you need is given in the problem. Second question is, analyze what would be the case if the required rate of return were 10%. Same problem. Solve 2 times, one at 15% and the other one at 10%. Then again compute IRR. Oh my God, how many things we have to do. And compute the project's payback period. Is it right? Say yes or no. What is the payback period? Very easy question, bonus marks. So write down first calculation of NPV. Calculation of NPV. Calculation of NPV. So this I have to solve two times, one at 15% discount rate and one at 10%. Can I solve in the same table? Yes, because we don't have to write same thing again and again. Year, cash flow. These two column will be constant. Then write down present value at the rate of 15% and present value at the rate of 10%. I will solve without writing discounting factor, okay? Don't worry, I am with you. Year 0, 1, 2, 3, 4, 5 dash 10. You want to write factor, you can just draw one more column, easier. No problem. Because there is an annuity factor also in the last. So I will write factor also. One column for PV factor, one for present value. PV factor, present value. Okay, understandable? Write nicely. One day you have to revise also. Your own notebook. This may be sufficient for exam. So first you have to read the problem carefully. In year 0, how much is your investment? 7 lakh. Year 1, again you have to make an investment of 10 lakh. So this time be careful, you have investment made in year 0 and in year 1. Then after tax cash flow will be 2,50,000 in year 2, very clearly written, and 3 lakh in year 3, 3 lakh in year 3, 3,50,000 in year 4, and 4 lakh each year throughout year 10, which means 5 to 10. Since factors are not given, we will write factor ourselves up to 3 digits. So take your calculator. 1 divided by 1.15 equal to, come on, reply. 1 divided by 1.15. Is it 0.870? Can I round off to 0.870? Yes, come on. 2,50,000. Okay. Again press equal to. Just press equal to, you get the factor. 0.756. Very good. Right. Press equal to. 0.657. Amazing. Next. 0.572. Can we make it 0.572? Now stop. Wait. Because it is not 5. It is 5, 6, 7, 8, 9, 10. Now many students are not able to crack this factor. Wait. Please give me some chance to speak. Okay. Because if you don't know, it's better to ask instead of suffering. So how do I get the factor of 5th to 10? It means I require factor of 5th, 6, 7, 8, 9 and 10. Understand the logic? I need to add the factors of these years on my calculator. So how do I do it? So first I will take 1 divided by 1.15 equal to 4 times. First 4 years I have already written separately here. Can you see that? Now you press equal to m plus. So that 5th year gets transferred to memory plus. Equal to m plus, 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 and then you press that MRC function in your calculator. So you will get something around 2.163 or 4, no problem. Are you getting now? This is the way you have to get the factor if it is between 5 to 10 or anything like that. First 4 factors do not transfer to m plus. Is it right? So now why are you waiting? Why don't you multiply and add them? Just the moment you get a chance, you sit down idly. Okay, that is the problem with this students nowadays, which is 8,70,000. Okay, it's not 10 lakh, sorry. It is 8,70,000 because it's year 1. Okay, next, the first two numbers put in bracket. 1,89,000. Okay, next one, memory plus. Use memory plus function nicely, huh? 197,400. This is 658. Make it 658. 197,400. Okay, next try. 2 lakh 200. 200. And then 4 lakh into 2.163.
It is 8,65,200.
Very good. 865,200. First you add all these positive numbers. Minus 7 lakh and minus 8,70,000. Anybody wants to tell me the total of this column? Positive or negative?
Negative 1,18,000.
Negative 1,18,200 approximately. No problem. 1,18,000 is also okay.
1,18,500.
No problem. Last 3 digits can be different. But it should be negative 1,18,000 and something. That is okay. Now we'll do the same thing for 10%. If you can just reply me faster. 1 divided by 1.10 equal to 3 digits.
909.
Again equal to.
0.826.
Again equal to.
0.751.
Again equal to.
0.683.
683. Now wait. On the screen below. I have written, type 1 divided by 1.10, press equal to 4 times. Now 5th to 10th time you will press equal to m plus MRC. Now you will get some factor on your calculator, which is the sum of the factors of year 5 to year 10. Good students will reply.
Sir, it is 2.974.
2.974 seems to be right. Okay. Other students will multiply now.
Sir, 7,909.
7 lakh,
9,09,000.
9,09,000 in bracket.
2,06,500.
2,06,500. Very good. Come on, next.
2,25,300.
2 lakh
25,300.
25,300. Amazing. 239,050. Very good. And last one. 4 lakh into 2.974. 11,89,600. Dear student, you are requested to tell me NPV of the last column.
20,69,460.
2 negative numbers are there in the beginning, minus the 2 negative figures.
Plus 26150.
251,450 you are getting. Check the again. Institute answer is 251,450 positive. I would ask you to check again because we have written all other figures same. So total must also be same.
729.
11,89,600, the last one.
Sir, 3,05,450.
Okay. Do it carefully. You can't. 251 something is okay. 251 last 3 digits can be anything. Still I will accept. Okay. you can't make mistake in total. In spite of all your hard work, you will get 0 marks. Question now write down here, advice. If discount rate is 15%, do not accept the project. Do not accept the project because NPV is negative. Because NPV is negative. Because NPV is negative. Write nicely. One day you have to read also. If discount rate is 10%, project is acceptable. Project is acceptable because NPV is positive. Because NPV is positive, it will increase wealth of the shareholder. It will increase wealth of shareholder. Try to practice more and more questions. Okay, so I am sure you must have understood. Such easy question they don't ask in the exam. This is the first problem for warm up purpose today. Okay, now my next question is understand IRR. Very easy, I can compute IRR. You can see on the screen when the discount rate is 10%. Can you see that? It is positive. But when it is 15%, it is negative. IRR is that discount rate at which NPV is 0. So my IRR would be somewhere between 10 and 15. 10 will be taken as lower rate and 15 will be treated as higher rate. So for IRR calculation, good luck. You don't have to again prepare the table. But in the exam, if only IRR is asked, first you compute the NPV at 10%. If it is positive, take 15%. And suppose it comes negative, which means you are sure that your IRR is between 10 and 15%, and then apply the interpolation formula right below. Step 2, calculation of IRR. So write down directly the formula. IRR is equal to lower rate, LR means lower rate, plus in bracket NPV at lower rate upon NPV at lower rate minus NPV at higher rate into higher rate minus lower rate. So lower rate is how much in our question? 10. We'll take 10. The one out of 15 and 10, whichever is lower, that is the lower rate. And what was the NPV at 10%? 251, 450. Then 251, 450 minus, again minus in bracket 118200. Whatever number you've written in your notebook, you use that for NPV. Into 15 minus 10. Kindly give me the answer. 13.4% approximately. Always write approximately because these are based on some estimates. So this is how you will calculate IRR. Okay, so this was an example of IRR. Now write down one more step, calculation of payback period method. Payback means simple payback without discounting. How much amount we have invested in this project? 7 lakh in first year and 10 lakh in the second year. Yes or no? So we have to recover 17 lakh. So write down year. We don't have to do discounting because it is just payback period. If they would have written discounted payback period, then we will discount it. And third column, write cumulative cash flow. Cumulative cash flow. So first add on year 2, 3, 4, 5, 6, 7, 8, 9, 10. Write separately because you have to take cumulative calculation every year. Okay. We have to see in which year we are able to reach 17 lakh. Okay. So year 2 cash flow is how much? 2,50,000. Year 3 is how much? Year 4 is how much? Very good. Year 5 is how much? 4 lakh. And then you keep writing 4 lakh. Understand? Do not use shortcuts. There are shortcuts, but exam purpose shortcuts will not give you marks. So first you write the question as it is. Now how much we have to recover? Remember 17 lakh. So the year in which we will reach 17 lakh, my answer will be over by that time. Okay. So 2,50,000 write down here, plus 3 lakh, plus 3,50,000, 9 lakh, plus 4 lakh, plus 4 lakh. Now wait, stop. In the payback period method, cash flows after payback period is not considered because my answer is over. My answer is that year in which we have recovered our initial investment. Yes or no? Yes. Right. So below that, first you write down initial investment. Our initial investment is 7 lakh in the first year and 10 lakh in the second year. So management wants to recover 17 lakh as early as possible. And therefore write down payback period is equal to, directly write down 6 years. Okay. Up to this you have done. Just one more thing I need to tell you. You have written payback period 6 years. Now write below, assume initial investment is rupees 15 lakhs. Suppose initial investment is 15 lakh. Now what will be your payback period? So this I wanted to explain. So when you get a situation like this where this is 13 lakh, this is 17 lakh, and we are assuming initial investment is 15 lakh. Is it right? So we have to find out between which 2 years we are recovering 15 lakh, between 5 and 6. It is more than 5 but less than 6. Yes or no? So it means 5 year plus 5 year minimum you have to go. You have to recover 15 lakh. You have already recovered 13 lakh in 5 years. And how much more you will get in the 6th year? You will get 4 lakh. So this 4 lakh you write here, so you will get a proportionate amount. You need 2 lakh, but the 6th year will generate 4 lakh. To get 2 lakh, you will require half year, so 5.5 years. So this way you will solve a question if the initial investment figure is not appearing in the cumulative cash flow column. Okay. So this was a question on NPV, payback period and IRR. Now we will, that was my addition to the question, 15 lakh. Otherwise, how will you learn the fraction part? Okay. So now we'll come to next question number 4747. Students are requested to come to your booklet where you will find question number 47. Keep turning pages. One day you will reach 47. Okay. And that day has come. A company wants to buy a machine and two different models A and B are available. Falling further particulars are available. Original cost 8 lakh, 6 lakh. Estimated life, good news, both are same, 4 and 4. So you can directly compare the NPV. Salvage value, one more good news, 0, 0. They should not have given only. The company provides depreciation under straight line method. Tax rate is 30%. Present value of rupee 1 at 12% discounting factor and net profit before depreciation and tax. They've given you net profit which is before deducting depreciation and tax. So whether depreciation is required to be calculated in this question?
Yes, sir.
Yes, because there is a tax liability. Presence of depreciation will reduce taxation. And then they have given you two machine A and B, PV factor, compute NPV, discounted payback period. So in this question we'll practice discounted payback period and we'll also practice profitability index. So this way the 5 main methods got revised with the help of these two actual question, and this is a January 2021 exam question for 10 marks. Suggest purchase of which machine is more beneficial under discounted payback period method, under NPV method and under profitability index method. So you have to also reply which is better. So we will say in case of discounted payback period method, whichever is lower. In case of NPV method, whichever has higher NPV. In case of profitability index method, whichever has higher profitability index. Okay. So first I need to find out one thing which is common in all the answer, and that is CFAT. Yes or no? All three methods would require what? Cash flow after tax. And you are given net profit before depreciation and tax. So first you deduct depreciation, then tax, and then add back depreciation. Okay. One by one we'll have to do because it is going to consume some time. So this is a problem of mutually exclusive proposals. Are you ready? So first you write down step 1. Step 1, calculation of CFAT, calculation of CFAT of machine A. Calculation of CFAT of machine A. So write 4 columns on the right side: year 1, year 2, year 3, year 4. $10 question in the actual exam of the institute. Why it is written January exam? Our exams are usually in May and November. That was an unusual year. Corona impacted year. Okay. So the exams were delayed by some months. So first you write down PBDT, profit before depreciation and tax. Preferably do not use short form in the exam. Preferably do not use shortcut in the exam, short form. Write down full. So this is your PBDT which is given. So less depreciation. What is the cost of this machine A? 8 lakh, life 4 years, scrap value 0. So can I write 8 lakh divide by 4 years? Income tax. What is income tax? What is written in the question? Which method of depreciation is written? Whatever is given in question, follow that. If two methods are given, then take income tax method. Okay. On your own, do not apply your knowledge. When the problem says only one method of depreciation in one question, that will be required to be used. I had given you a note that if two depreciation rates are given, one under books of account, one under tax law, then use depreciation rate as per tax law. Keep the whole paragraph in mind. Don't select few words and then understand. So next point, write down PBT. PBT A minus B. Anybody wants to reply? 30,000, 40,000, 20,000, 3,60,000. Point number D, tax at the rate of 30%. So 30% of, write down on your calculator 0.3 into 30,000. 9,000. Now just press 40,000 and press equal to. You'll get the magic 12,000. Again 20,000 equal to 6,000 rupees. And 3,60,000 press equal to 1 lakh 8. Wait a minute. Point number E, write down CF80. Now you'll wonder, how will I get CF80? I have not written PAT. I have not written add back depreciation. This first line is my PBDT, means cash inflow. It is basically sales minus your cash expenses. Okay. So that is cash inflow. Depreciation is a non-cash column. PBT is non-cash column. Tax is an outflow. Tax is outflow. So can I write A minus D, or suppose you are not convinced, C minus D plus B. C minus D will give you PAT, and PAT plus depreciation. You will get same answer. You can try. So first you try 2,30,000 minus 9,000. Okay, try one more. 30,000 minus 9,000 plus 2 lakh. You will get same answer, but that takes less time. The first method takes less time. A minus D will take less time. Next one, 2,28,000, 2,14,000. Last one, 4,52,000. Now write step 2, same thing. CF80 of machine B. Keep understanding, keep writing. Write down year 1, year 2, year 3, year 4. So start first point A. PBDT. How much is PBDT for machine B? Anybody? First year. First year PBDT. 1,75,000. One's saying 6 lakh. I don't know what he's saying. It was only indicator of lack of concentration. Okay. Your life is revolving around that Instagram and whatnot. So teacher is asking PBT, student is asking investment amount. So less depreciation. What is the initial investment? 6 lakh. What is the life? 4 years. There is no scrap value. So whatever method they will give you, follow that. Is it 1,50,000? Don't apply WDV if not specifically mentioned.
Yes, sir.
Okay, income tax law may require, but the question does not mention WDV purposefully because it consumes lot of time for a student in the exam. Then you write down PBT
25,000.
25,000, 1,10,000, 1,70,000.
1,70,000.
Zero point buddy. Tax at the rate of. Take on your calculator 0.3 into 25,000. 7,500. Now 1,10,000 into 0.3.
33,000.
33,000. Wonderful. Then next column 51,000. Last column I will tell you. Zero. Without calculator. See
Yes, sir.
my power. I can calculate without calculator. Now write down CF80. Same format, A minus D. A minus D will help you to do it faster. 167,500. 2,60,000 minus 33,000. 27. 2,27,000. 320 minus 51. 269. Last one, 1,50,000. So first you do this basic working, which will give you CF80. CF80 can be A minus D or C minus D plus B. Wait a minute, on the screen, I have to compute NPV, I have to compute discounted payback period. Is it right? And I have to compute profitability index. What is common in all the three? We need to find out PV of cash inflow. We need to find out PV of cash inflow. Outflow is only this much, 8 lakh and so I will design the format in such a manner that it gives me all the three answers in one table. Do you agree?
Yes, sir.
So I don't have to prepare separate working note for NPV, discounted payback and profitability index. So write down in the same format we'll get calculation of NPV. Write down discounted payback. With practice we'll get such ideas that you can save time in the exam. Otherwise you'll have to prepare separate table for each of them. Okay, say yes. First column write year. Year column is common for both. Then write machine A. Under machine A, we have three columns.
Yes, sir. I got it. How will be the format?
Cash flow, present value at the rate of what is the discount rate in the question? Any idea? 12%. So present value at the rate of 12% and discounted, write down discounted cash flow. Discounted cash flow. Now write down machine B. Under that, cash flow, present value at the rate of 12%. Last column, discounted cash flow, or you can write discounted present value. So this time write down year. How many years are there? 4 years. So first we will compute PV of cash inflows. First we will compute PV of cash inflows. How much CF80 you have computed in the previous table for machine A? Go to previous table. Machine A, last line, CF80. Oh, no.
What do you want?
What do I want? I want this line. I want this line.
21,000, 2 lakh.
Wait a minute. Who requires total? Do I have to write total or I have to write year wise?
2,21,000.
Okay.
2,28,000. 2,14,000.
Take it from the previous working notes. Okay. Go to previous working note of machine A. You will find in the last line we have computed CF80. Now it is right. This line on the screen once again. And for machine B also please reply.
Sir, 1,67,500.
167,500. 2,27,000.
It is 2,65,000.
2,69,000. 9. Yes.
1,50,000.
Wait. This is first you copy from there. Now listen to me. You have to find the present value at 12%. So type 2,21,000 divided by 1.12 equal to divide by 1.12 equal to memory plus how much is memory plus? 197,321. Okay. Now 2,28,000
190.
divided by 1.12, 2 times equal to 181, 68, 60, memory plus 2,14,000 divided by 1.12, 3 times equal to equal
152,321.
152,321 memory plus 4,52,000 divided by 1.12, 4 times equal to
287,254.
287
287,254.
memory plus memory recall
8,18,657.
8,18,000.
657.
Okay, no problem. Now we'll take cumulative values. 197,321. This is for discounted payback period. Okay, next one. Add please. Next one. 3 lakh something.
3,79,081.
379,081.
081.
Very good. Next one.
531,402.
531,402. Next one.
818,656.
818,656. Don't take total, not required. How? These are two different. Okay, make it 7. These two figures must be same. Okay. You are doing the same thing. Okay, no problem. No problem. Let us move ahead. For 1 rupee, we will not fight. We have so many other things to fight for. So write down this 167,500 divided by 1.12 equal to, and memory plus also 160
149,554.
554 memory plus 2,27,000 divide by 1.12, 2 times equal to 189,63 memory plus. Memory plus function will save time for calculation. 2,69,000 divided by 1.2.
191,469.
191,469. Wonderful, amazing. Memory plus 1,50,000 divided by 1.12, 4 times equal to. Again.
95,328.
95328 is right. Memory plus memory recall.
Sir, 6,17,313.
6,17,313. This is PV of cash inflow. Okay, now for discounted payback period, I need to compute the cumulative cash flow. You write here the word cumulative. Cumulative word is not written. Cumulative. And here also write down cumulative. Cumulative discounted cash flow.
Cumulative.
Or just write down cumulative present value. Anyway, can you just add these two numbers for me?
Why not, sir?
Yes, come on.
3517.
3
3517.
3517. Okay, wonderful. Next.
521986.
521986.
Yes.
Okay,
Sir.
again, come on. Next.
And that is last one.
It should match with this number. Both are same.
617313.
617313. Please take total properly. Please take total properly. If you can't take total, you will make faltu mistake, unnecessary mistake. That will cost you a lot.
61.
Okay. Now write down NPV. NPV machine A. NPV for machine A will be 818657 minus initial investment was 8 lakh. So it will be
18656.
18657, no problem, plus minus 1. And machine B write down NPV machine B 617313. Can you see that?
17313.
Minus how much?
6 lakh.
Minus 6 lakh is right.
And which is equal to 17313.
17313.
313. Which is higher than
Right below decision. Decision based on NPV. So if you have to take a decision on the basis of NPV, which one will be selected? So write down machine A. Machine A will be selected. Machine A will be selected as it has higher NPV. Machine A will be selected as it has higher NPV. Wait a minute. Up to this you have written. Then I am going to erase now.
That's okay, sir.
Then write down below. Next question is discounted payback period. Go according to question.
Payback period.
So write down discounted payback period. Answer B.
Discounted payback period.
Discounted
Machine
payback period dash
initial investment.
machine A. Now we have invested how much? 8 lakh
Initial
rupees.
investment.
Wait a minute. We have invested 8 lakh rupees.
Yes, sir.
Go to this cumulative discounted cash flow column. You have to find in which year you have recovered 8 lakh. So it is recovered between year 3 and 4. More than 3, less than 4. Yes or no?
Plus
So I will take 3 plus
8
in
minus
bracket.
131.
I have to recover 8 lakh minus 531402 I have recovered, divide by this number 287254. Come on students.
287.
28725, this figure which I am circling right now.
Sir, it's 0.935.
3 plus 0.935, so 2.935 years approx. Write down.
935.
Yes, 2.935 years approximately.
Yes, sir.
3.935 approximately.
Machine.
And write machine B.
Initial investment 6 lakh.
So here we have invested 6 lakh. So again we will just understand last column on the screen.
3 years.
I have recovered in 3 years time 521,986. So 3 years plus initial investment 6 lakh minus recovery in year 3 521,986 divided by recovery in the 4th year is 95328. Calculation must be done fast. 3.818
Sir, 3.818.
years, right, approximately. And you please write one note. I am going to dictate.
Sure, sir. No.
Note, write down.
Machine.
On the basis of discounted payback period, machine B should be selected. Machine B should be selected. Machine B should be selected because discounted payback period is lower. Because discounted payback period is lower. Understood?
Yes, sir.
Because discounted payback period is lower. Now, I am going to erase again. Do you have any objection?
No, sir.
No. Even if you have objection, keep it with yourself. Okay. Now, next is profitability index. Write down point number 3. Profitability index. First write formula is equal to PV of cash inflow upon PV of cash outflow.
For machine A.
Done. Below that write machine A is equal to,
818656
can you see 818657 on the screen? Inflow
upon 8
upon 8 lakh. Upon 8 lakh. Come on.
658.
1.0.
Sir, 1.02332.
1.023. Okay, 1.023. Below that write machine B.
Sir, it is 6,17,000.
So you will write 6,17,313 divide by 6 lakh. 1.028.
1.028.
This is higher.
281 is high. Machine B, according to note.
So this is higher. So now again write down on the basis of profitability index method. On the basis of profitability index method. On the basis of profitability index method, machine B is selected as PI is higher. As PI is higher. So you have learnt with the help of this example how to compare two or more projects and take decisions. Understood? Any query on question number 47, which was an exam question for 10 marks? Okay. So now we'll take a break. Okay, now welcome to question number 28. This question was asked in, not this one. Anyway, just come to 28 number taken from study material. XYZ Limited is planning to introduce a new product. Question 28. In your study material, question number 28. Our study material, question number 28, and this question source is study material of the institute. Planning to introduce a new product with the life of 8 years. Underline life of 8 years. Initial equipment cost will be 3.5 crores. Very good question. Additional equipment costing rupees 25 lakh will be purchased at the end of third year. Underline. So this time you will have to purchase two equipments, one at the beginning and one at the end of third year from the cash inflow of the year. At the end of year 8, the original equipment have zero resale value. So original equipment zero salvage value, but additional equipment can be sold for 2,50,000 salvage value. And tell me what will be the life of original equipment? 8 years. What will be the life of additional equipment for depreciation calculation? 8 minus 3, 5 years. Because it was purchased at the end of third year. But both will be serving 8 years. So therefore, for depreciation calculation, this is important point. There are two assets we are using in the business. One will have 8-year life, one will have 5-year life. A working capital of 40 lakh will be needed and it will be released at the end of 8th year. So working capital year 0 you will take 40 lakh and you will recover it in the 8th year, entire 40 lakh. Working capital is not depreciated. Okay. The project will be financed with sufficient amount of equity capital. Sales volume of 8 years have been estimated as follows. So this time you have to do some extra calculation. Sale is given in quantity. Sale is given in quantity year wise 1, 2, 3, 4, 5, 6, 7, 8. 4 and 5 will be 2,70,000, 6 and 8 will be 1,80,000. A selling price of 240 per unit is expected and variable cost is amounting to 60% of the sales revenue. So what is my contribution per unit? Contribution per unit, anybody? 240 is the selling price and variable cost is 60% of sale revenue. So contribution would be 96 per unit. Do you agree?
Yes, sir.
Yes. Fixed cost will be 36 lakh per year. Underline one new adjustment. The loss of any year will be set off from profit of subsequent 2 years. Which means suppose there is a loss in any year, it can be carried forward for how many years in this problem?
2 years.
Only 2 years. So within 2 years you have to set off the loss of that year, otherwise that loss will lapse. Tax rate is 30% and 12% is the after tax cost of capital, means discount rate 12%. The company follows straight line method of depreciation, very easy. Compute NPV and advise the management to take appropriate action, decision. So in this question, one task will be to find out CFAT of each year and then we have to find out the NPV. Then we have to find out the NPV. Is it right? So what we'll do, we'll first prepare some small working notes to reach our answer. Students will write step 1 on the screen below. Contribution per unit. Contribution per unit. Student will write contribution per unit. Please write contribution per unit. Have you noted contribution per unit? 240 minus 60%. 240 minus 60%. Write important question. Such questions are asked in the exam for 8 to 10 marks. This one was not asked in the exam. Some other question that will take 96 rupees per unit. Done. Step 2, depreciation. Depreciation. Under depreciation, write down A on original equipment. On original equipment. So on original equipment, depreciation will be what is the cost? 3.5 crore. So we will say 350 lakhs minus 0 salvage value and divide by 8 years. Divide by 8 years. So can you please? 43.75 lakhs. We'll solve the question in lakhs. Okay. Then write down on additional equipment. Now here the student can make a mistake. He may take 8 years, but it was purchased after 3 years. So how can it be 8 years? So here the cost of the additional equipment is 25 lakh and it will have a salvage value of 2.5 lakh minus 2.5. We have to follow straight line method of depreciation and divide by 5 years. 3 years are over. So that is 4.5 lakhs. Is right, 4.5 lakhs. Now we'll prepare the main working note, calculation of CF80. Step 3. This is important. Here we will see tax adjustment also, depreciation adjustment also. So highly important question. First column write year, then you write down sales in units, then write down total contribution at the rate of rupees 96 per unit. Then you write cash fixed cost. Cash fixed cost we have to deduct. Then you have to write depreciation. So total contribution minus cash fixed cost minus depreciation will give you PBT. Yes or no? And then you pay tax. What is the tax rate in this question? 30%. So tax 30%. And then we'll calculate CF80. Little lengthy table. Column number also I will write for your future reference. Column number, if there are many columns, better to write column number. 1, 2, 3, 4, 5, 6 equal to 3 minus 4 minus 5. Agreed? 7. And 8 will be equal to, column number 3 is contribution, which is inflow. Column number 3 contribution, you will get inflow. Column number 4 is cash fixed cost outflow. Column number 5 is depreciation. Column number 6 is PBT. Don't take 6 and 5 and 6. Column number 7 is tax outflow. So you will get CF80. So inflow minus, this is inflow column, this is outflow column, and this is outflow column. Or you can write, if you are interested, 6 minus 7 plus 5. 6 minus 7 plus 5. If you are happy with that, you can write that also. Whatever helps you to understand better. Now we are back to calculation now. Please write down. Now follow year 1, year 2, year 3, 4-5, 6-8. Because we are following straight line, depreciation will also be constant for those years. Agreed? Yes. Sales quantity, please copy from the question book. Please practice this question independently yourself. Any other presentation is also okay as long as you are getting same answer which should be understood by the institute. Sometimes you understand your answer only. Others can't understand. Then there is a problem. Now you write here rupees in lakhs. So you will save time. If you want to write all digits, you are most welcome. So you will multiply 72,000 into 96.
69 lakh 12,000.
69.12. 69.12.
1 crore 3 lakh.
No, you answer in lakhs. Answer in rupees in lakhs. Please, I reply. I ask you to answer.
103.68.
Haji, 103.68. Don't confuse others. Next one.
249.6. 249.6.
249.60. It will save time, na?
259.2.
259.20. Okay, wonderful. Next, come on.
172.8.
172.8. Everybody. Read the problem and you will reply now. What is your cash fixed cost?
214.
What is your cash operating fixed cost? 36 lakh. Write down 36 lakh. Very good. Wonderful. 36 lakh. Okay, wait. Depreciation we have already calculated above. First, second and third year, it will be only original equipment. It will only be first, second and third year 43.75. Wait. But then from fourth year till eighth year, you have to add 4.5 also. So you can, what you can do, you can just add here. You will get the total 48.25 if you have space. Or if you have space here in the table, you can do that. I will request you to keep one line blank after each year in the tables. Okay. So sometimes it is easy to write some working 43.75 plus 4.5. Otherwise, later when you revise, you wonder how this 48.25 has come. Last minute revision, you get tensed. Oh, now the student will have to use mathematics, contribution minus cash fixed cost minus depreciation. You may get negative figure, don't worry. First year can be negative also.
Minus 10.63.
10.63 negative. Wonderful. Okay, next below that. Now you'll get some positive answer.
23.93.
23.93. Come on, next one.
Sir, 169.85.
169.85. Wonderful. Next one. This is a time consuming question. With practice, you can do it faster.
Sir, 174.45.
174.95. Anyone? 174.95. Just one more.
88.55.
88.55. Now just wait. This time you have to learn something new. There is a loss in the first year. Highlight. Now if you read the problem, I'll just go to the previous problem, go to this problem, and it says the loss of any one year will be set off from the profit of two subsequent years. So in income tax, they allow you to carry forward the loss and adjust against future taxable income. Correct? So in this case, I have a loss here to 10.63. So first year tax liability will be nil because there is loss. But what about the next year? You first type on your calculator 23.93 minus the carry forward or brought forward loss and then into tax rate. What is tax rate for this question? Is it 30%? So anybody wants to
3.99.
3.99. Okay, so put an asterisk mark here. Asterisk mark. And you put an asterisk mark here also. 3.99. So that you can check the asterisk mark below later. And now you just simply take 30% of 169.85.
50.955.
50.955. Wonderful. Next.
52.485.
52.485. One last.
26.565.
26.565. You are right. And show the asterisk mark calculation below if you want to write, or you can just give the heading tax of year 2 equal to second year tax liability. You can write. Every working note must be presented, not only for you but for the examiner also. Noted? And don't make mistake in basic calculation. Institute will not worry about what happens to you. They will worry about their own bank balance, their own CFAT. Okay.
Yes.
So the moment you give them a chance to earn again from you, you'll grasp the opportunity. Sometimes you are also right. Okay. Now column number 8 is 3 minus 4 minus 7. So dear student, take 3, type 3 minus column 4 7 in the first year is 0. So just take 3 minus 4.
691.
33 point. Very good. 33.12 positive. Who said minus?
3.21 na?
12. If it is 1 2 here, it will be 1 2 here also, dear. Why are you wasting time of the entire class? You have right to ask query, but not like this. Next one.
Sir, 63.69.
63.69. Very good. Come on, next one.
Sir, 162.645.
162.645. Okay, come on, next one. Student will have to reply, then only I will write. 170.715. Very good. 3 digits are enough. Next one.
110.235.
110.235. You are right. Amazing.
110.235.
Any query now? Now we are ready to launch the main answer, NPV calculation. Okay. Any query up to this? So we are following the instruction given in the question that loss will be carried forward and set off in next 2 years. How many steps we have written? 4 or 5? 3 we have already written. Now write down step 4. Calculation of NPV. Calculation of NPV. So write down format year, particulars, cash flow, right here rupees in lakhs at the top. Then write down present value factor at the rate 12%. It is given, so I am taking. Respect the institute, okay? And the last column, present value. You will respect them, they will respect you. Second sentence you can fill yourself, okay? So my question is now, have you drawn the format? Then I can start writing and you can ask query related to this question. First you identify in year 0, what are the cash flows? There are 2 cash flows in year 0. One is cost of original equipment. Yes or no? So particular column will tell you what is that cash flow. So 350, you are writing in rupees in lakhs. And the factor for this is 1. Year 0, there is a working capital also. You have to invest in working capital. That is given to you is 40 lakh. Read the problem, you will find it. Present value factor is 1. Later on you can multiply and take total. Year 1 write down CF80. CF80 of year 1, where will you get it? In bracket write step 3. I'll just take you to the step 3 and show you. You have to copy these numbers, okay? Whenever I will ask you, last column, 33.12 positive, positive. And the first year factor is 0.893. Wait a minute. Year 2 write down CF80. Go to previous table.
Sir,
Can you answer how much was that?
63.69.
63.69.
0.797.
And what is the factor? 0.797. Year 3 again CF80. Can you please reply?
162.645.
162.645. Third year factor in the question book.
712.
Okay. Wait. Third year there is one more cash flow. Additional equipment. Oh,
Oh my God.
some students forgot this.
No.
This is how much is given in the problem?
25 lakh.
25 lakh. Factor will be same 0.71 2, this you write in bracket. There is an outflow. Then you write 4-5, 4-5 CF80. What was that? 4-5 CF80 was how much?
170.745.
715. Yes, 170.715. Now what you do, on your calculator you add, please add 0.636 plus 0.567
0.636
plus 0.567.
the 1.203.
1.0203.
1.203 and
1.203. Okay, wait a minute.
628.
Then write down 6-8 CF80. And what was the cash flow of that 110 point?
Sir, it is 1110.235.
235.
0.2.
And please take your calculator,
1.363.
add 1 point,
363.
factor you have added 6, 7 and 8. Wait, answer is not over. 8th year, there are 2 more inflows. One is salvage value of additional equipment. Do you remember salvage value of additional equipment is there in the problem? 2.5 lakh. So 2.50 positive. 8th year factor in the question 0.404. Can you see that factor table given? And 8th year, one more thing write down. Recovery of working capital. Working capital will be recovered in the last year. It's not depreciated. Assume it is 100% recovery. So that is 40 lakh and that is 0.404 again. Now you have to multiply and calculate NPV. Do it as homework. Do it as homework. All figures I have given. So what the students will do, they will just multiply and add it. Your answer should be very close to 161.11 positive. Only multiplication is your homework. And right below advice. Right below advice. Because you have to answer what is the appropriate decision management has to take. So advice, write down, the project should be undertaken. The project should be undertaken. The project should be undertaken because the NPV is positive. Because the NPV is positive. Because the NPV is positive. And then in the exam you will also say positive NPV increases the wealth of the shareholder. Positive NPV increases the wealth of the shareholder. Now come to question number 53. Question number 53, November 22 exam for 10 marks. This question also is based on NPV comparison of 2 options.
53.
Yes. Question number 53. I'll read the problem. One of the very interesting questions, and many students asked me after the exam that it was a very difficult question and we have not done it. A firm is in the need of a small vehicle to make deliveries. It is intending to choose between 2 options. One option is to buy a 3-wheeler. One option is to buy 3-wheeler that would cost rupees 1,50,000 and will remain in service for
10 years.
10 years. So year 0 cost is 1,50,000, life 10 year. The other alternative is to buy a second hand vehicle for rupees 80,000 that would remain in service for 5 years. So they are not equal, but what they have done, they have said thereafter the firm can buy another second hand vehicle for rupees 60,000 that will last for another 5 years. So now they are comparable.
But
So one is 10 year, other is 5 plus 5. So first 5 year you will use the vehicle which will cost 80,000. Another 5 year you will use the vehicle which will cost you 60,000. So both option gives you chance to use the vehicle for 10 years. So now only you have to compare their NPVs. Follow the instruction given in the exam. Do not apply your own intelligence. The scrap value will be equal to its WDV. Underline, this is another new adjustment. Scrap value will be equal to its WDV, which means whatever is the WDV after the life is over will be the salvage value, which means the student will have to find out for the first option salvage value at the end of 10th year, and in this case salvage value of first second hand vehicle at the end of 5th year and second hand vehicle at the end of 10th year. Oh, so there will be two salvage value in the second option. Understood? The firm pays 30% tax and is allowed to claim depreciation on vehicle at 25% on WDV basis. The cost of the capital of the firm is 12%. You are required to advise the best option.
So if that 60,000 that second-hand vehicle was not due, then 80,000.
If 60,000 was not given, then it will become a problem of equivalent annualized cost.
Then repeat.
Then we will repeat the first second hand vehicle one more time, but because it is given we have to take two times. Okay, now this question does not have any source of sales or income. Can you see that? So the objective will be to minimize
The cost.
the present value of cash outflow, because it has only outflow, and in future you have benefit in the form of tax shield on depreciation and some salvage value.
So same question 25.
This does not have revenue model.
Our question 25 in book.
So question number 53, write down. All questions are there in your study material also. You have to just practice all questions. Okay. I will start writing now. We have limited time. Kindly follow me. In this question, there are very few cash flows. One is year 0 investment. Then for 10 years, you will get tax shield on depreciation. And in the 10th year, you will get salvage value. These are the three cash flows of the new three-wheeler option 1. Am I right? Because there is no sales. There is no cash fixed cost. So the question is only asking you to compare two options and choose the option which will have lower PV of cash outflow. So we'll solve. It will take some time, but then you can score 10 marks. In one table, we'll solve option 1, new three-wheeler. Write down new three-wheeler. First option is to buy new three-wheeler and directly write down calculation of NPV. Similar question is there in the study material and they just made some changes and asked in the exam. WDV makes the time, makes it a time consuming question. Okay. Had it been straight line, it could have been done in just 2 minutes. Then how will the institute earn? They are also having liquidity issue. Based on asking many students, how was your paper? Most of them said it was very difficult. One student said, sir, I have not calculated depreciation only. How many marks I will get? So will you get marks for writing year 0 cost of the machine only? Year, one column write cost of machine. Then write down depreciation, under depreciation 3 columns. Opening WDV, depreciation at the rate 25%, tax shield at the rate 30%. Then write salvage value in one column. cash flow column, all we will add whatever are the cash flow related column, and last column present value at the rate 12%. Present value at the rate, what is the rate of discount? 12%?
12%.
Okay, can we start writing?
Sir,
Write column number 1, 2, 3, 4, 5, 6, 7, 8. So first you write down column numbers. Have you written 1, 2, 3, 4, 5, 6, 7, 8?
yes, sir.
In year 0, we are going to incur 1,50,000 in the cost of machine, correct? So my cash flow will also be 1,50,000 only, and my PV would be also 1,50,000. Are you agreeing? Yes. Now I will calculate depreciation. Next 10 year we have to just compute tax shield on depreciation, okay? Because there is no other cash flow mentioned in the problem. But depreciation tax shield is cash inflow. Yeah. Calculate 1,50,000 into 25%. Lot of calculation involved.
So
37,500 into 30%. 30% of depreciation is tax shield. Tax shield, yes. What else we can calculate? There is no cash flow in the problem. There is no other cash flow. So the only cash flow is in the problem tax shield on depreciation. 11,250. Salvage value in the last year. So don't worry. 11,250 divide by 1.12 equal to memory plus. Okay, approximately 10,044 you are getting.
10.45.
Write down 10,035 or 45 is okay. Is it 45?
Sir.
Okay, make it 45. 10,045 write down. I have no problem. Then year 2 write down your opening WDV will be. Opening WDV will be, understand, this minus this. 1,12,500 into 25% into 30%.
8438.
Cash flow 8438 divide by 1.12, 2 times equal to
6,726.
yes 6725 write down 6725. No problem, 6725, 1 or 2 rupee plus minus, okay. Now you have understood the process what you have to do for 10 years. Difference between opening and closing WDV, opening and depreciation, you write in the next year as opening WDV. Then you take 25% of that. Then you take 30% of depreciation. 6328 you are getting. Divide by 1.12, 3 times equal to. Approximately 4499 you are getting. If you multiply by the factor given in the problem, you will get this number.
4, 5.
Is the factor given in the problem? Just check.
Yeah.
So you can multiply by that factor. That is why we are getting a difference of 1 or 2 rupees. Okay, try 4th year. Little fast, please. I am preparing you for a very difficult exam. 63281 into 25%. Use both hand. Left hand for calculation, right hand for writing.
15820.
15820 into 0.3. Yes.
4746.
4746 divided by 1.12, 4 times equal to. And use memory plus function if you are using.
3014.
3014. Multiply by that factor in the problem. 3014. Or you can do yourself also, no problem. Either use the factor or do yourself. Next year opening WDV, come on.
47,461.
Into 25%.
71865.
Into 30%.
Sir, 355, sir, 3560.
3560. 3560 into fifth year factor.
3560
Into fifth year factor.
0.567. Sir, equals to 2019.
2019. 2019. We are solving question number 53. November 2022 exam. Very important. 35596 into 0.25.
Into 0.25. Sir, 8899
into 0.3.
into 0.3. Sir,
70 into the sixth year factor given in book. 2670
into
Two-
0.506. Sir,
1351. Very good. Year 7.
Year 7.
Some patience required and you get 10 marks.
Sir, 26697
26697 into 0.25.
into 0.25. Sir,
6674 into 0.3. There is no shortcut.
002
There is no shortcut. Into seventh year factor from the book.
452. Sir, 905
905. Now it is matching with my answer. Yes, 20023 into 0.25 into 0.25
697
5006 into 0.3 2 into eighth year factor 605 ninth year opening WDV 15017 into 0.25 3754 into 0.3 into ninth year factor
3754
complete up to this. Now we're in the last year, don't worry. Last year opening WDV 11263 into 0.25 3816 2816 into 0.3 845 845 into 10th year factor 272, and in the 10th year you will get salvage value also. Now how much salvage value? Understand, salvage value will be the WDV after 10 year. After 10 year WDV will be 11,263 on the screen minus 2816. So you will get this salvage value. So it is a difference between these two numbers. If you want to write in bracket here 11263 minus 2816. That is why I prepared a format like this, so that in last year I can explain you the salvage value. What is written about salvage value? Salvage value is equal to WDV after the life of the project. So 10 year is the life. WDV is 8447. 8447 into 10th year factor. Into 10th year factor. Please write down in the notebook. If you think that by reading the answer you will understand this chapter, you are making a grave mistake. Okay. That is the reason why FM subject has such a poor marks in the exam for most of the students. They read capital budgeting answer. Haji, very good. Now the $1 million task is take total of all positive number and then minus 1,50,000. That is the NPV of three-wheeler. New option. Students are requested to give me the NPV of the last column. It will be a negative figure because there is no revenue model here.
minus 117,432.
approximately minus 1,70,400 something you are getting. That is okay. 450, 460, 430, 420. 117 is there. 4 is there. Then you enjoy. This is 117, 460. So the present value of the new three-wheeler is 117, 460. So that is your cash outflow in present value terms. Now write down option 2, second hand vehicle. Haji, second hand vehicle format is more or less same. Please draw the format. The drawing format is also an art. Okay. Unnecessary columns you have to avoid. At the same time, necessary columns must be presented in a proper sequence. This you will learn with more and more practice. So I am assuming you are ready with the format? No. Okay, one more minute. Write in the notebook. Write in the notebook. When you write, you learn more. When you only watch, you learn less. Okay, ready?
We are done with the format. So
Keep one line blank after each year if you can,
machine.
so that you can write some calculation, some explanation. So what will happen in this second hand vehicle? You will first buy a second hand vehicle which will cost you 80,000 and you will use it for 5 years. And after 5 years you will purchase another second hand vehicle which will cost you 60,000. So write down year 0, cost of the machine 80,000, cash flow also 80,000, cash flow also 80,000, present value also 80,000 because it is year 0. Then you write down year 1. Now we'll calculate depreciation, tax shield on depreciation. 80,000 into 0.25, 20,000 into 0.3, 6,000. Salvage value will come in the 5th year. So till then, you please just calculate tax shield and present value. 6,000 multiplied by first year factor 0.892 multiply 5352. Then it will match with the institute answer also. Year 2 opening balance 60,000 into 0.25, 15,000 into 0.3 into second year factor given in book 0.797, 3587. Okay, no problem. Year 3 opening WDV 45,000 into 0.25, 11,250 into 0.3 into third year factor 0.711 multiply 2400. Year 4 opening balance. Keep writing. Practice is very important. Okay, mugging up will not help you. Shouting the formula will not help you. You have to involve yourself, okay, in writing the answer. 8438 into 0.3, 2531 into fourth year factor. Fourth year factor
1.365. Sir,
1607. Okay, 1607. Now wait. Stop. Fifth year at the this old asset will have a life of 5 years. After 5 years will be over, you will purchase a new machine for 60,000. So 60,000 write down in 5th year. 60,000, understood? But the old machine will be depreciated for 5th year also. So again take the difference here. 25312 is the difference of these two. Old machine will go up to 5th year, then into 0.25,
6328
then into 0.3.
1898.
Now stop. In the last year, this old asset will be sold for the difference between 25312 and 6328. So you will get a salvage of the first machine which has a life of 5 years. Yes or no? So student will write here 18984. How did you get it?
The column
25312 minus 6328. Write in bracket if you have space. Okay, now wait. This year, 5th year has 3 cash flows. I will explain. 5th year has 3 cash flow.
tax shield.
Add on your calculator. Tax shield you add, salvage you add,
And minus 60.
and 60,000 will be deducted because it is outflow.
Negative 39118.
So negative 39118. Is it understandable? So you can just circle this 3 number for your future reading. Right. And then you multiply by 5th year factor.
So that is 0.56,
Multiply and give me the answer.
59999.
39118 into 5th year factor. Once again. Into 5th year factor. 22180.
221.
If this is confusing, then in the year 5 you write 3 times. One write down tax shield, one write down salvage, one write down new asset. Okay, so that will consume more space. Is it understandable? Similar problem is there in study material also. Year 6 now. Now we'll start depreciating this asset. Now we'll start depreciating this 60,000.
15,000.
Same thing, repeat 5 years. I will not tell you anything, do yourself. Check the last column yourself. 6th year I am getting 2277. Are you also getting?
2277.
7th year, try 7th year. Just few more lines. This is a lengthy problem, but has been asked in the exam. You can't avoid it. If you want to avoid it, your choice. By solving only easy question, you will not get through this difficult exam. 7th saal, 7th year, what is the answer?
1526.
7th year 1526, very good. 8th year, student will try himself. Now you see, there is a repetition. Can you see? See, this is a repetition here. So you can just copy the same numbers.
1020.
Yes. But the factor is different. So last column don't copy, okay? Next one, copy the first 3 columns because the pattern we are getting is same. 1898 into 9th year factor. 683. Last year. Last year opening WDV. Tell me quickly. 18984.
18984.
Then 4746.
4746.
1423.
1424.
No problem. And what will be salvage value in the last year? The difference of these two numbers will come here. Difference between 18984 minus 4746 will be salvage value here. 14238. Have you understood?
Yes.
Or you want me to write?
No, sir.
18984 minus 4746. And take the total of these two numbers, both are inflows. So that will be the 10th year cash inflow. 15661 into 10th year factor. Into 10th year factor.
5043.
5043. Now my highly talented students will take the total of this last column. There are 2 negative figures, remember. And there are remaining positive numbers. So net NPV, keeping in mind negative figures also.
So it becomes how much?
Keeping in mind negative figures also. Yes, please reply.
Minus 95623.
There is 120 to 180 also in the center. Have you
Minus 78685.
7 8 something you are getting?
78.
That is okay. 78,000 something is okay. 78,000 some amount is okay. I am sure you can't make mistake in totaling, but it's okay. This combination of two second-hand vehicle will cost you in present value term 78786. That figure was, I think, more than 1 lakh or something. Yes or no?
1,70,400.
Yes. So what companies should do?
Option 2.
This is a good question. This is how companies do their capital budgeting exercise. They actually do such calculation because all figures are already advanced, fixed in advance. You know, this is the cost of machine. You know, these are the depreciation tax shield you are going to get. Okay.
Can we calculate the cost?
Just write down the advice on the screen. Last line, advice. Option 2 is preferable. Option 2 is preferable because PV of cash outflow is lower. In both options we have outflow, so we have to choose the lower of the two. Now don't say, sir, you have told me NPV is higher, then we should select. That is if it is positive. Then one student will say, in both cases NPV is negative, we should reject. Hello dear, this question does not have revenue model. This question only wants you which machine I should buy so that my cost is minimized. Okay.
We are just the revenue sources.
One more line, write down, note. Yes. Tax shield is not like a revenue model. That is not the intention of buying an asset.
But to minimize my cost.
Yes. As salvage value is equal to WDV, as salvage value is equal to WDV, no capital gain tax will arise. No capital gain tax will arise. No capital gain tax will arise. This way you can present the answer. Any other presentation is welcome as long as we are getting the same answer. So we have solved question on today, NPV, profitability index, discounted payback period, IRR. Now we'll take one question on equivalent annualized cost. When will you use this method? Come on.
When the lifetime is not.
Yes, when you are comparing two or more options with different life, Okay, so then
Yes.
this method is going to generate answer quickly. Question number 25, very important. A, B, C is planning to invest in machinery for which it has to make a choice between two identical machines in terms of capacity X and Y, despite being designed differently. Both machines do the same job. Apple mobile phone and Samsung mobile phone, they do the same job, whatever is required. Yes or no?
Yes.
But they have different life, different cost, different revenue structure, different cost structure. Further details regarding both machines are given below. X, Y, cost 15 lakh, 10 lakh. Life 3 year, 2 year. Running cost. Running cost. What is running cost? Running. This is running cost. Then what is running cost? Operating cost.
Operating cost.
Operating cost. Operating day-to-day running of the machine means all your fuel power will cost you 4 lakh and 6 lakh. Now all numbers are different. Very difficult to compare directly by looking at the numbers. Is it right? So we have to make them comparable by a concept called equivalent annualized cost or benefit. Cost of capital is 9%. Identify the machine which company should buy. Present value factors are given. Now tell me in this question, is there any revenue in this problem?
No, sir. Only cost.
There are only two costs. Cost of machine and running cost. Is there depreciation in this problem?
No, sir.
Do we need to calculate depreciation in this problem?
No, sir.
The answer is no.
Because there is no time.
Because there is no tax, no taxation, no depreciation. Okay, so very easy question actually. I will first compute the present value of cash flows under two options. I will calculate present value of cash flow under the two options. Divide by annuity factor. Select the option which has lowest PV of cash outflow. Because this question does not have any inflow. Is it right? It does not have any inflow or revenue. This question does not have even tax shield also, because there is no tax rate given. On your own, don't assume tax rate. As assuming tax rate is 30%, problem is to be solved like this. Don't make your life miserable. It's already too much miserable. Okay, that you know more than me. Heading: calculation of equivalent annualized cost. Calculation of equivalent annualized cost. Right hand side, two columns. Machine X, machine Y. Are you with me? Those who are with me, they will get rank. First point number A, cost of machine in year 0. So this does not require discounting, or does it require discounting? Year 0 cash flow, do they require discounting? Say yes or no. No, 15 lakh. So this I will write directly without writing any PV factor. Then point number B, write down the running cost per annum per year. 4 lakh, 6 lakh, point C, life in years 3, 2, point D, PV annuity factor at 9%. Wait a minute. In your study material, they have given you the factor.
Yes, sir.
So you add these three, this will give you PV factor for 3 years. And you add the first and second, which will give you PV factor for 2 years. Come on, please reply fast.
2.531.
2.531. First and second only. Add first and second only.
Sir, 1.759.
1.759. So point number E would be PV of running cost. Running cost will be incurred for 3 years in case of machine X. So multiply B into D. That will give you present value of running cost of 3 years.
B into
BD.
10 lakh 12,400.
10 lakh 12,400. 6 lakh into 1.759.
1.759. Sir, 10 lakh 55,400.
1055,400. Point F, write down PV of cash outflows. In this problem, A is also outflow, E is also outflow. Is it right? A plus E, come on.
20 lakh 55,400.
25 lakh 12,400. This is 10 plus 10, 20, 55, 400. right now you will be tempted to say machine Y is better because
No.
outflow is lower, but if you invest in machine Y, you incur this amount for a 2 year period only. You can use the asset for only 2 years in that amount. But if you buy machine X, you will incur this cost, but you can use it for 3 years. But I can't directly divide by 3 and divide by 2. Why? Why? Time value of money is ignored. If I divide by 3 and divide by 2, so time value of money is ignored. So I have to divide by third year annuity factor and 2 year annuity factor. Annuity factor is already printed in the answer, yes or no? So I will not write annuity factor again. I'll divide F by D. So point number next, write down equivalent annualized cost. PV of cash outflow divide by PV annuity factor. Do it nicely on your calculator. 25, 12, 400 divided by 2.531.
Sir, 9,92,651.
992,651. Amazing. Next one.
Sir, 11.
Take on your calculator this number. Divide by 1.759. 11 lakh 68,505. Okay. Now you can compare them in a better manner. Again, understand, if you buy machine X, it is equivalent to spending 992,651 every year. That means it will cost you 992,651 every year per annum. Okay. So all cash flows converted into one single number for comparison purpose. That investment in X will cost you 992,651 per annum. But if you buy machine Y, it is equivalent to incurring 11,68,505 per annum. So which is a better option or cheaper option? X, because our objective is to reduce our cost here. Okay, so write down advice. Advice, right?
This is outflow. Equivalent.
Cost. That is why I've written cost. EAC. C stands for cost. This is costing you this amount per annum. This is costing you this amount every year. Is it right? That means this one number can be used for comparison directly. So please write advice. Company should buy machine X. Company should buy machine X because equivalent annualized cost is lower. Because equivalent annualized cost is lower. Equivalent annualized cost is lower. Question was from your study material. Likely question in the exam. In the past they had asked this question some years back. Okay. In the exam they have asked this question. So we have taken one problem on equivalent annualized cost. Now we'll take one question on replacement. Question number 48.
From morning I'm getting doubt.
There is no doubt. This is very simple.
No, I know it is written in the theory and that.
No, there is no theory. You have, suppose, consider this cash flow. So you are getting 25,12,400 for using the asset for 3 years. Okay. Now, if instead of everything, just forget everything. Suppose you incur 992,651. I said you take my machine, just give me 992,651 every year, nothing else. So what is the present value for 3-year period? You will multiply by 3-year factor, which is equal to 2.531, and that will give me the same answer, 25,12,400. Yes or no? So by buying a machine yourself incurring running cost for 3 years gives you so much PV of cash outflow. Instead of that, you can incur this amount every year. This also gives you same PV. So this one number has converted all other numbers into a single number. Is it right? So can I say incurring, can I say, okay, you have to understand, can I say incurring 15 lakh in year 0 and 4 lakh for 3 year is equivalent to, come on, fill in the blanks, is equivalent to 9,92,651 every year. Incurring 10 lakh in year 0 and 6 lakh for year 1 and 2 is equivalent to incurring 11,68,505 per annum. Okay.
Got it.
So that is the meaning of equivalent. It's like average, but we are just not dividing by 3 and 2.
We are dividing by
Annuity factor of 3 and 2 years, so that time value of money is also taken into account. Is it right? Okay. So just write one assumption in this question. Please write one assumption which is actually not required, but because the students are interested, we will write assumption. It is assumed that which interpretation already explained.
No, sir, please.
You can
In statement.
no. It is assumed that the machines can be repeated. Machine can be repeated more than once. Machine can be repeated more than once. So after every 3 years, you can repeat it. Is it right? Again, you incur the same cost. And second assumption is the cost and running cost will remain constant. Cost and running cost will remain constant, means after 3 years, if you want to buy this machine again, it will cost you the same 15 lakh and the running cost will continue to remain 4 lakh per annum. Okay.
So that
See, I have tried my best to explain. You have to keep your ear, eyes, mind open.
yes, sir. Open, but interpretation little.
So write down interpretation. For one machine I will give you
Yes.
interpretation of EAC. Interpretation of EAC. Incurring rupees 15 lakh in year 0. Rupees 15 lakh in year 0. And rupees 4 lakh per annum. And rupees 4 lakh per annum for 3 years. And rupees 4 lakh per annum for 3 years is equivalent to incurring a cost of rupees 992,651 per annum for 3 years. Is it right?
Yes, sir.
In this question, there are only two cash flows. There could have been tax shield on depreciation also. There could have been some revenue also. So this one number substitute all numbers of that machine so that you can compare these two numbers. Okay, so now we'll take a question number 48. Question on replacement 48. So this will cover lot of variety of questions. Okay.
40.
48. Tick mark question number 48. variety. Only when you solve a large variety of questions, you will get that confidence. Question is little lengthy, so we'll do it fast. You will help me with the calculations. Okay. Problem on replacement. Very good question. An existing company, this was in July 21 exam, 10 marks. Oh my God. July 21 exam, 10 marks. Many students will leave by looking at the size of the question, but actually it is not very difficult. An existing company has a machine which has been in operation for 2 years. Okay, so what is the number of years already completed?
Has been completed after 2 years.
2 years. So how many years are remaining? 4. Its estimated remaining life is 4 years and 0 residual value. So now we have only 4 years remaining. So 4 year will be relevant. Understood? Its current market value is 3 lakh. So if I sell it today in the market, I'll get 3 lakh. So 3 lakh is the replacement value or realizable value today. So that is my opportunity value of this old machine. That is my opportunity value. 3 lakh is relevant. The management is considering a proposal to purchase an improved model of a machine that gives increased output. So that is usually the purpose of replacement, to increase output. The details are, the old machine was purchased 2 years ago for 6 lakh. The new machine will cost you 6 lakh. The life is 6 year, life is 4. But remember, out of 6 year, 2 years are completed. So 4 year. This is also 4 year. When the remaining life and life are equal, we will compute incremental NPV. We will not use EAC or EAB. If this was given anything more than 4 or 5, more than 4 year or less than 4 year, then EAC, EAB method will be used. Okay. Residual value for both are 0. So that is good for us. Now next is annual operating days, 300 days, operating hours 6, which means total number of hours in a year 1800. It looks like a costing question. Selling price 10 rupees, material cost 2 rupees, operation output per hour in units. So 1800 hours in a year, 1800 years, 300 into 6. Multiplied by output will give you annual quantity. They should have given directly only. They are wasting human time and talent in this. Some people will make mistake in that also. We students find mistakes where they don't exist also. Okay. We have such a good quality, such a talent. Even where institute can't imagine, we can make mistake there. Labor cost per hour, number of hours into labor cost per hour will give you total labor cost. Such a simple question. Fixed overhead per annum excluding depreciation. Excluding depreciation means cash fixed cost. Working capital 1 lakh, 2 lakh. Income tax rate same 30%. Assume cost of capital is 10%, that is discount rate. Company uses, this I don't like, they make our task little lengthy. WDV method, which means every year you have to compute depreciation, and it has several machines in 20% blocks. So we'll apply block of asset concept. When you are following incremental approach, I will repeat, you have to follow incremental block value, and depreciation will be provided on the increase in the block of asset value. Sale of old asset reduces the block, purchase of new asset increases the block. So the impact on the block is the difference between the purchase price and the sale price. Purchase price of new, sale price of old. Advise the management on the replacement as per NPV method. So when they specify the method, you have to follow that. So first what I'll do, step 1, calculation of increase in block of asset. Calculation of increase in step 1. This question institute answer is very big, but we will simplify it for you. They have written so many unnecessary working notes, not really required. Calculation of increase in, more practice is required. Block of assets for depreciation calculation. Depreciation will be calculated using block of asset method, because it's written here also. Company has several machines in 20% block. So they are giving you a hint. You are a student of tax also, I assume. Income tax law says that when you buy an asset, it will increase the block of asset. When you sell, it will decrease the block of asset, and you will get depreciation on the differential amount. Is it right? So suppose it is earlier X, you buy an asset for how much? New asset will cost you how much? 10 lakh plus 10 lakh, and you sell the old asset for 3 lakh, that is the current value. So your block of asset will become X plus 7 lakh. Am I right? Earlier it was X, now it is X plus 7. So by what amount the block value has gone up? 7 lakh. So we will get additional depreciation on 7 lakh. We'll get additional incremental depreciation. Our decision will help us to get additional depreciation on 7 lakh rupees. Okay, our decision to replace will give us more depreciation by 7 lakh rupees. So write down purchase price of new asset 10 lakh, which I have explained you with the help of algebra also here.
Yes, sir.
Whichever way you understand, less sale value of old asset 3 lakh, increase in block of asset value. Block of assets are block of asset which are subject to same rate of depreciation, which is equal to 7 lakh.
A minus B.
Any query? 7 lakh rupees. Any query? So first step, what you do, find out the additional block, incremental block. Step number 2, find out incremental PBDT.
Yes.
Incremental PBDT. And then we will compute NPV. Okay. Step number 2, calculation of incremental PBDT. Little fast. Incremental PBDT. So here you write first column. PBDT means, right now I will not consider depreciation and tax in this working note. Existing, new and incremental. Existing, new and incremental. Because other figures are not changing, only depreciation is changing. Because of that, you will have to make two separate working. So first A, write down annual output. What will be annual output under existing machine? You have 300 days into hours, 6 hours, 300 into 6, and output per day. So annual output will be 300 into 6 is how much? 1800. into output per hour in units into 20. So you write here 300 into 6 into 20, 36,000. Here you write down 300 into 6 into output is 40 here. This is doubly efficient machine. So are you getting 72,000? Say yes. Yes. So you will get 36,000 units extra in the new machine. Point number B, write down sales revenue. Sales revenue is output into, what is the selling price? Rupees 10 per unit. Output into 10 rupees per unit. Output into rupees 10 per unit. So that will give you 3,60,000. Sale revenue will be quantity multiplied by selling price. Selling price is 10 rupees for both. Is it right?
Yes,
7,20,000. So incremental revenue you will generate 3,60,000. Point number C. Material cost will be output into, what is the material cost per unit? 2 rupees. In the question, please keep question in front of you.
material cost for the
2 rupees. So 36,000 into 2. 72,000 into 2. 1,44,000. Additional cost will be 72. One more thing, write down labor cost. Labor cost is based on hours. Labor cost is based on hours. What is the labor cost per hour? 20 and 30. So here we will have 300 into 6 into 20. 300 into 6 into 20, 36,000. Here we'll have 300 into 6 into 30. 306 into 300 into 6 into 30 rupee per hour. Hour 54,000. You are right. So what is the incremental labor cost? 18,000. One more, right? Fixed overhead in bracket cash, not excluding depreciation. Excluding depreciation. So what is the fixed overhead given in the problem for machine, existing machine? 1 lakh. Is it 1 lakh? And how much is there? 60,000. So you will save 40,000 here. You will save 40,000 here. Any query? Point number F, write down. PBDT. PBDT will be B minus C minus D minus E.
over here. 152,000.
है जी
152,000.
1,52,000. Okay, next.
462,000.
4,62,000. Now here it is minus will become plus. Okay, ध्यान, keep in mind. 3,60,000 minus and this will become plus because it is already minus. Anybody for the last column? Yes, this must be right because I have to use this figure. You can cross check. The difference of these two columns will be equal to this. Okay, so suppose you don't have time in the exam, then you can ignore this entire column and only below you can write incremental cash flow. Suppose you don't have time in the exam, because that is also right. Is it right? But if you have time, then follow the institute's presentation, because many of them follow the presentation of the institute for marking purpose, even though your answer may be right. Now the next big calculation is CFAT and present value. So next you write down step 3 NPV. Next write down NPV. Year PBDT. Exam question for 10 marks. Don't take it lightly. After that we'll calculate depreciation at the rate 20%. We will get PBT. We'll calculate tax at the rate 30%. We will get CFAT. We are given PV factor in the problem at 10%, and therefore we'll get present value. Now understand carefully. How many years? 4 years. Keep one line blank after each year and write year 1, 2, 3, 4, 5. Have you written? Now PBDT write down 3,10,000 4 times. Column number you want to write? Okay, homework. Already you know this. Don't worry.
3, 4, 5.
Okay, I will write column number also on public demand. Column number 1, 2, 3, 4 will be 2 minus 3. 5. 6 will be
2 minus 5.
2 minus 5. 7. 8 will be 6 into 7. Right. So depreciation, we have prepared one working note. Increase in block of asset for depreciation. Do you remember? How much was that? Working note 1. 7 lakh into 20%. 7 lakh into 20%. 7 lakh into 20%. Yes. Now I will tell you a small trick. Multiply by 0.8. First you take 0.8 into 1,40,000. 0.8 into 1,40,000. Just press equal to now. See the magic.
89,600.
Again press equal to and see the magic.
680.
So you got the depreciation like this. Okay. PBT. Column 2 minus column 3. Kindly reply.
140 minus 3. 170.
1,70,000. Yes. Next.
Sir, 198,000.
1,98,000. Next.
Sir, 2,20,400.
220,400. Next.
Sir, 2,32,320.
238,320. Yes. 671,680.
Sir, 238,320.
238,320. Now I will tell you one more trick. Type 0.3 into 1,70,000. 0.3 into 1,70,000.
51,000.
Yes. Now you just type the number and press equal to.
59,400.
You'll get the answer. 59,400.
66,
Type the number, press equal to. 66.
120.
Very good.
71,496.
71,496. Any query?
Sir, 259.
Column 2 minus 5 will give you CFAT. Yes, come on.
Sir, 2,59.
Student is saying 2,59,000. You are right.
2,50,600.
250,600.
243,880.
243,880.
Sir, 238,504.
238,504. Factor you copy from the book. When the factors are given by the institute,
Take the institute.
then respect. Okay. Otherwise, they will disrespect. Their disrespect will cost you a lot. And now what you will do, you will use the memory a plus function when you multiply these two columns. Use memory plus function, round off the last digit. Round off the last digit.
2, 3, 5, 4, 3, 1.
2, 3, 5, 4, 3, 1. Come on, the next one. Yes, come on.
206996.
206996. Very good. Come on, next one. You can do it. Yes, yes, come on.
Sir, it is 183154.
183154. Amazing.
183154. Abhi 238.
162, how much?
0.683. Sir, 162898.
Okay. If you are using memory plus memory recall,
Sir, it is
this will give you PV of CF80. Haji?
788479.
788479.
79. Yes, sir.
788479 is right. This is the PV of cash flow of the 4 years. But we have to also adjust the initial investment and the terminal values. Is it right? Any query on this till now? No. Write down below. Draw this line. Draw this line. And below this line, right hand side,
Rupees.
write rupees. So I'll just write it here because I need little more space. So we have to write first PV of CF80, which you have just now computed 788. 788479.
Yes, sir.
This is my in between year CF80. Okay. Then you write down purchase of new asset in year 0. No, 10 lakh. Or write down, don't worry, I'll write that also. This will be outflow. Year point C, sale of old asset. Yes or no? In year 0. Or what you can do, you can combine them and write 7 lakh. That is also okay. You can write 7 lakh, you can write 10 lakh separately, 3 lakh separately. Point number D, write down incremental working capital in year 0. Incremental working capital in, how much incremental working capital you will incur? New will be 2 lakh, old is 1 lakh. So you have to put 1 lakh more.
2 lakh minus 1 lakh.
So in bracket write down, it is an additional working capital investment, but this 1 lakh will be recovered in the last year. Don't forget that. Recovery of incremental working capital. Sometimes students forget this, okay? In the 4th year. So because it is 4th year, I will have to multiply by 4th year PV factor 0.683. So which will give you 68,300. Do we have any incremental salvage value in this problem? Do we have incremental salvage value in this problem? Both have 0 salvage value. Oh my God, since both have 0 salvage value, we will ignore incremental salvage value. 0 minus 0 is 0. So can you please take the total of the last column, that is NPV. Carefully, without mistake. Positive or negative?
Negative 243221.
Just do it carefully one more time.
2, 5, 6, 7, 8.
Just do it properly. I can't expect a student of intermediate making mistake in just adding 5 simple numbers.
Sir, 56779.
56779 after 3 attempts. Okay.
No, sir. Second.
What's a second? Positive or negative?
Positive.
So what is the advice?
Sir, you should go.
Right, company should replace. It's a problem of replacement. So your answer will be company should replace.
Since NPV is positive.
Company should, write slowly, nicely. Company should replace the old asset. Company should replace the old asset
Old asset.
by the new one.
New world.
Because incremental NPV is positive. Because incremental NPV is positive.
Yes, positive.
Because incremental NPV is positive. Write one note. Note. It is assumed that sale of asset will not affect capital gain tax. It is assumed sale of asset will not affect capital gain tax. Okay, so now this answer is over. Hello and welcome to this important chapter, risk analysis in capital budgeting. Now we are going to revise this chapter and take some important questions, right? So write down risk analysis in capital budgeting. Revision. One day before the exam, you can just revise this much. Okay. So first we have to understand expected value. Expected value means average or mean. Average or mean. So how do you compute it? Expected value will be equal to sum of the observation multiplied by probability. Observation can be cash flow, observation can be cash inflow, cash outflow. For example, if you have to compute expected cash flow, then you will take summation of cash flows multiplied by their probability. Is it right? So that gives you expected value. Then we have seen the formula of variance. Variance means deviation of data from the mean. Deviation of data from the mean. Higher variance means higher deviation. Higher variance means higher deviation and higher risk. And higher risk. So how do you calculate variance? Variance is equal to sum of x minus x bar square into p. And what is x bar here? Expected value, which we have calculated above. And what is p here? Probability. And then we calculate standard deviation. Standard deviation is the square root of variance. It measures risk. It measures risk. Okay, it is a measurement of risk. Higher standard deviation means higher risk, and lower standard deviation means lower risk, and vice versa. Lower standard deviation means lower risk. So standard deviation is equal to under root variance, or directly under root summation x minus x bar square into probability. Is it right? So these are called statistical technique for understanding the risk. These are the statistical tool for evaluation of risk. Then the fourth concept we have seen is coefficient of variation. Coefficient of variation. In short, CV. It measures risk per unit of return. It measures risk per unit of return. It measures relative risk. On the screen, it measures risk per unit of return, and it is useful for measuring relative risk. So we use the concept of coefficient of variation when we have to compare two or more projects. Useful for comparison. Two or more projects. Useful for comparison of two or more projects when risk and return are different. When risk and return are different. Is it right? So formula is coefficient of variation is risk divided by return, or more specifically standard deviation divided by expected value. Okay. Higher the CV, higher the relative risk. Higher the CV, higher the relative risk, and vice versa. Between two projects, one with lower CV, between two projects, one with lower CV will be selected. Is it right? If the risk and reward both are different, compute CV, and the decision will be based on CV because it gives you lower risk per unit of return. What is the reason? You want to write reason because it gives lower risk per unit of return. That is coefficient of variation. The fifth concept in this chapter is called risk adjusted discount rate, RADR. Risk adjusted discount rate is short called RADR. Here higher discount rate. Here higher discount rate is used for projects with higher risk, and vice versa. Vice versa means lower discount rate is used for project with lower risk. Is it right? So how it is calculated? So one formula is risk adjusted discount rate is risk free rate plus risk premium or RF plus beta into RM minus RF, or RF plus beta into RM minus RF. RF means risk free rate, this is beta, and what is RM? Return on market portfolio. Return on market portfolio. Return on market portfolio. The third is sometimes institute will give you the discount rate directly. Is it right? The institute will give you discount rate directly. How many concepts we have read? 5. The sixth concept in this chapter is certainty equivalent coefficient. Certainty equivalent coefficient is called CEC. Is it right? Here, uncertain cash flows are converted into certain cash flows by multiplying by certainty equivalent. Please write. I am making a small summary of this chapter for you, which will be required a day before exam. Uncertain cash flows are converted into certain cash flow by multiplying by certainty equivalent coefficient. Okay, so you will be given risky cash flow. You convert into risk-free cash flow and then write down, apply risk-free discount rate, to calculate present value. Apply risk-free discount rate to calculate present value. Okay, formula. First formula is CEC formula. Keep writing if you are interested candidate, genuinely interested. Okay, otherwise watch the show. Certainty equivalent coefficient equal to formula certain cash flow divided by uncertain cash flow. We'll solve a question in next few minutes, then I will further explain with the help of number. Or second formula, certain cash flow equal to CEC multiplied by uncertain cash flow. Then write down range of CEC. What is the range of CEC? Between 0 to 1. One indicates certain cash flow. 0 indicates highly uncertain cash flow. Highly uncertain cash flow. So investment in government bond has a CC of 1. Loan given to Daud Ibrahim, gangster Daud Ibrahim, not normal person. Okay, I hope he does not watch my video, otherwise your remaining syllabus will not be completed. You will take pen drive. But you have to record it, na? So this is CEC. Is it right? Next concept we have learned. How many concepts are there? 6, 7. Sensitivity analysis. So what does sensitivity analysis does? It measures the impact of change in a variable on NPV. It measures the impact of change in variable on NPV. Also, it measures by what percentage. Also, it measures by what percentage a variable must change to make NPV 0. By what percentage a variable must change to make NPV 0. Okay. Then write down sensitivity percentage will be equal to change divided by base. Change divided by base. Then write down in sensitivity analysis we change one variable at a time keeping other variables constant. Keeping other variables constant. We change one variable at a time keeping other variables constant. Okay. Eighth, write down scenario analysis. Scenario analysis. So it is a little advanced version of sensitivity analysis. Here we calculate NPVs under different scenarios. We calculate NPVs under different scenarios. The scenarios can be worst case, most likely, and best case. Right. Here we change more than one variable at a time. Here we change more than one variable at a time. Thus, it helps us to identify the risk associated with the project. Thus, it helps us to identify the risk associated with the project. Is it right now? So, based on this discussion and some example that we will take, you will be able to understand this concept again fully. So, on all these concepts, we will take some examples, then you can understand even better. Are you ready? Louder, yes. Yes. So please come to question number 9 in our book. Our class note is a comprehensive book covering all question of study material, RTP, MTP, exam, covers all varieties of question also. Question number 9. 10 mark question. Can you see that 10 mark question? November 2020 exam. Are you ready? Say yes. This question is very, very important. Pre-practice is required. Okay. Pre-practice means you have to practice in advance. And with the help of this one question, we will practice standard deviation, we will practice expected value, we will practice variance, we will practice coefficient of variation also. So one question will help us with so many concepts. Shivam Limited is considering two mutually exclusive proposal A and B. Project A cost 12,000, project B cost rupees 11,000. You have been given the below and net cash flow and probability for each project. So you are given following cash flows with their respective probabilities. So do you know how to get the expected value? You will multiply and add them. Summation cash flow into probability. So first you multiply, then summation. So that will give you expected cash flow, and this will fetch you, let's say, 2 marks. Just multiply, add, you get 2 marks. What more do you want in life? Compute the risk attached to each project. Risk means standard deviation you have to calculate for both the projects. So we'll practice standard deviation. Compute the profitability index of each project. Calculate the profitability index of each project. Identify which project do you consider, which project will you recommend. State with reason. Have you studied profitability index in earlier chapter? Formula. PV of cash inflow upon PV of cash outflow. Okay. And which project would you recommend and why? So that we will see later. Okay. So let us solve one by one. First we'll write down step 1, calculation of expected cash flows. Go according to the question. Write down in step-by-step manner. Question is from study material and exam. This question is also in the study material. Calculation of expected cash flows. We will draw a table with the following columns. Under that we'll draw total 6 columns. Project A will have 3 columns and project B will have 3 columns. Keep calculator ready. The columns will be cash flow, probability and expected cash flow. Again cash flow, probability and expected cash flow. Write nicely. Avoid short forms. For getting full marks, write full. If you want half, write half. Choice is yours. I will give you column number also. 1, 2, 3 will be 1 into 2, 4, 5, 6 will be 4 into 5. So that in future when you revise again, you'll understand. So cash flows are 15,000, 12,000, 10,000, 8,000 and probability is 0.4. Keep writing. Use calculator. Learn to solve faster because exam gives you very limited time. Paper is very lengthy. Very few people are able to complete 100 marks. Is it 6,000? Memory plus. Next one. Memory plus. Keep adding in memory. Memory plus. 800. Memory recall. 12,400. Wonderful. Project B question book in front of you. 15,000, 12,000, 10,000, 8,000. Is it right? And then probability is given 0.3, 0.5, 0.1, 0.1. Yes. 4500 memory plus. 6,000 memory plus. 1,800 total. This total is called expected cash flow. 12,300. This is 12,300. Any query on this question? No query. Now write down step 2, calculation of standard variance and standard deviation. So that you will learn variance also and standard deviation also. Calculation of variance and standard deviation. Again we'll solve in one table only. Project A, 3 columns, cash flow, probability. In cash flow column write here X. In probability column write P. In the last column write X minus X bar square into P. And what is X bar equal to? Expected value of A, which is here 12,400. Can you see that? So every time you have to deduct 12,400. I hope with lot of practice you will be able to do it faster also. And then we have project B, same 3 columns. First you write down cash flow. This time you write Y just to differentiate. Probability write P. And here you write down y minus Y bar square into P. So again copy the 2 columns from the booklet. 15,000, 12,000, 10,000, 8,000. Correct? Probability 0.4, 0.3, 0.2, 0.1. So how do you get this column? I will help you. 15,000 type on calculator minus 12,400. into equal to into 0.4. So you are getting 27 lakh 4,000. Okay, one more chance. 12,000 minus 12,400 into equal to into 0.3. 48,000. 10,000 minus 12,400 into equal to into 0.2. 11 lakh 52,000. 8,000 minus 12,400 into equal to into 0.1. 19 lakh 36,000. Total. This total is called variance. Variance. So that is 58 lakh 40,000. And right below standard deviation equal to, just in the same column, under root 58 lakh 40,000. So you can write here, you can write below. I don't have it. 2416.61. Okay, this is good enough. So this way you present the answer. If you don't have space, write below. Any query on project B? A? No. Now we'll try project B. What is your cash flow in the question book? 15,000, 12,000, 10,000, 8,000. Cash flows are same, but probability is 0.3, 0.5, 0.1, 0.1. And what is y bar here equal to? It means expected value of project B. Y bar is expected value of project B on the screen below right side 12,300. 12,300. So you will take 15,000 minus 12,300 into equal to into 0.3. 21 lakh 87,000. Wonderful. Next. 45,000. Very good. Next. Do the calculation and then tell me. Is right. Okay. Next one. 18 lakh 49,000. Total. This is total is called variance. Total is called variance. Total is how much? 46 lakh 10,000. And then below that write down standard deviation is equal to under root 46 lakh 10,000. Square root of variance is called standard deviation. 2147.1 approximately write down. So first question was compute expected cash flow, we have done. Compute risk attached, that is standard deviation, that also we have done. Okay. What is the third question? Profitability index. Since you are a highly talented student, you will find and tell me. Student will reply this answer, profitability index of each project. Step 3. Calculation of first chance to the student. Profitability index. Yes, who will reply for project A and who will reply for project B? First you try, then give me the answer. 1.03. So for that we need what is the PV of cash inflow? This will get from step 1. 12,400 and second one was 12,300. Assuming these cash flows given to you are in present value terms. Okay, this question has a small mistake. What is the mistake? They have not mentioned cash flows given are in present value terms or not. But there is no discounting factor, so we can assume they are already in present value terms. Point number B, PV of cash outflow, which is given in the problem first paragraph. 12,000 is for project A and 11,000 is for project B. So therefore, profitability index
1.0
formula A upon B 1.033
and it's 1.12.
1.118. You can write 1.212.
4. Identify so that the
Wait, one more line, right? Step 4, calculation of coefficient of variation. Yes, their cash flows are different. You see on the screen, cash flows are different, standard deviation are different. Okay, project A, project B. So coefficient of variation is equal to standard deviation upon expected value. Standard deviation upon expected value. Standard deviation of project A, previous answer, step 2 answer. Project A on the screen, 2416.61, this figure. 2416.61 and expected value is 12,400. Answer in points, answer in decimal.
0.1948.
0.1948. Second one, the standard deviation is here on the right side below 2147.1. 2147.1 and it is 12,300.
0.1745.
0.1745. Now you can answer better. If you look at the profitability index, project B has a higher profitability index and it has a lower coefficient of variation. It has a lower coefficient of variation and it also has a lower standard deviation also. So there are three good reasons why project B should be preferred. Okay, so write down recommendation or advice. Project B should be preferred. Project B should be preferred because A, B has higher profitability index. B has higher profitability index. Then write down B has lower standard deviation. B has lower coefficient of variation. So it has lower risk. So it has lower risk. Is it understandable? Yes, sir. So this question was for 10 marks. And if you go prepared in the exam, you can score 10 marks. It won't take much time also. Okay. So in this question, expected value, standard deviation, variance, coefficient of variation, profitability index, all formula got tested. Good question. For exam purpose, they should again ask. Now we'll come to November 2022 exam question for 5 marks. What is the question number? Question number 34. Determine the risk adjusted NPV of the following projects. So this question will help you with risk adjusted NPV. So the concept of RADR will be used here. There are 3 projects ABC: net cash outflow, project life, annual cash inflow, coefficient of variation is given. Means risk per unit of return is given. The company select the risk adjusted discounted on the basis of coefficient of variation. Underline, company adjusts risk adjusted discounted on the basis of coefficient of variation. So if the project has 2.2 coefficient of variation, which means it is greater than 2, it will have discount rate of 25% because it has a higher risk. Higher CV indicates higher risk. So they are using a higher discount rate because project A has a higher risk. 1.6. Where is 1.6? Here. So what discount rate we will use here? 18%. And project C has a lower coefficient of variation. Means lower risk. 1.2. This is 1.2. And what discount rate will use for this project? 16%. And to help you, your Ultra Kind Institute has given you the PV annuity factor also. So you just have to multiply these factors with this cash flow, get PV of cash inflow, deduct the outflow, and that will give you NPV. Which project should be selected on the basis of risk adjusted NPV? So the decision will be based on NPV. The one which has higher NPV will be selected. Bonus mark. I will tell you, this is a bonus mark. Just one table and you get 5 marks. Write down. Calculation of risk adjusted NPV. Calculation of risk adjusted NPV. Right hand side 3 columns. Project A, Project B, Project C. Done. Draw the format first. Good student will write everything in detail. So can we start now? If you allow me, write point A, net cash outflow. Copy from the question book. 70,000, 1,20,000 and 2,20,000. Do you agree? Right. Point number B, write down coefficient of variation. coefficient of variation. Under that you write down 2.2, 1.6, 1.2. So that will help us to identify the risk adjusted discount rate. Point number C. Risk adjusted discount rate. Risk adjusted discount rate. So how much is that? Will you take 25, 18 and 16. Then write down annual cash inflow. Annual cash inflow. 30,000, 42,000 and 70,000. Wonderful. Now write down PV annuity factor. PV annuity factor for 1-5 year. Already given in the question. This is already given in the question. 2.689, 3.127, 3.274. Yes or no? If you multiply D and E, you will get PV of cash inflow. Come on, PV of cash inflow. Multiply D into E. Yes, who will give me the answer first? 80,670. Come on, next one. Next one. 131,334. Come on, next one. 229,180. 229,180. Are you there? Last line, NPV. E minus A. Right? E minus A. E minus A. A. E is inflow, A is outflow. So on your calculator, 10,670, 11,334, 9180. 9180. Are you getting it? Very good. This way you will present the answer nicely. If the question asks you which project you will select on the basis of risk adjusted NPV, these are the risk adjusted NPV. So your answer will be that project which has highest NPV. So write down the decision. The company should select project B. Come on. The company should select project B. Company should select project B. Because expected NPV is highest. Because expected NPV is highest. Because it has highest expected NPV. Now you get 5 marks for this much effort. So this was an example on RADR, risk adjusted discount rate. Any query on this? If no, why are you sitting idle? Go to question number 13. One practice we will do on certainty equivalent coefficient. Okay. So this will revise your certainty equivalent coefficient. Question number 13. Giri Limited. Which limited? Giri is using certainty equivalent approach in the evaluation of risky proposal. The following information is given. Year 0, 1, 2, 3, 4, 5. Cash flow CE. Riskless rate of interest on government security 6%. What will you do with that? What will you do with that? Answer that. Don't repeat my question. We'll use it as a discount rate. Okay. Determine whether the project should be accepted. First we'll check NPV. If NPV is positive, accept. Source of this question is study material. Repeated in November 18 RTP and similar question in 2020 May RTP. So what should we do? Solve? Yes. Right. Write down the heading calculation of NPV. Calculation of NPV. Give question number 13 in our book. All varieties are covered. This will be asked in your exam also. First column write year, second column write cash flows, in bracket uncertain cash flow. This will be multiplied by certainty equivalent coefficient. You will get cash flows which are certain. Certain cash flow will be discounted by the risk-free discount rate, which is 6%. So present value at the rate of 6%. Directly we'll calculate present value. Is the factor written in the question book? Factor at 6% is not written? Not written. Factor is not written. Rate is written. Column number 1, 2, 3, 4. 4 is 2 into 3 and 5. Then you copy the first 3 columns from question as it is. Only for adding 2 extra columns you are getting marks. What more do you want in life? Year 0, copy from the book without any changes. 0 is 4 lakh. Yes or no? Please write down also in your own interest. This question is in your study material also. We are trying to ensure that you cover maximum number of questions, maximum varieties of questions. You do lot of practice. You get confidence and you pass the exam. That is what I aim for. But then you also have to work little hard. These 3 columns are given. Certainty equivalent indicates 0.8 indicates that if 1 rupee is uncertain cash flow, I am willing to accept 80 paise certain cash flow. So we will multiply and convert into its equivalent certain cash flow. That is the meaning of certainty equivalent. Come on. 2,56,000. Is the student right? Is the student right? 1,96,000. Others will check. 1,56,000. Very good. Come on, everybody. 96,000. Yes, very good. 48,000. Now take your calculator. First write 4 lakh in bracket. If you don't have factor, then you can do it directly on calculator. Also use memory plus function. Type 2,56,000. Divide by 1.06 equal to memory plus. Try again. 2,56,000 divided by 1.06 equal to anybody 2 lakh 241,509. Okay, memory plus 1,96,000 divided by 1.06. 2 times equal to 174439. Memory plus. Come on, next. 13,981 memory plus. Next one. 041. Very good. 48,000 divided by 1.06. 5 times equal to 35868. 35868. So this method reduces your effort and there is no rounding off problem also. Memory recall. Minus 4 lakh. 2,58,839. 258. This is NPV. NPV is 258. Then write decision. Would you like to write decision on your own? What is the decision you will write? Since NPV is positive. Accept the proposal. Is it right? Since NPV is positive. And also write, it increases the wealth of the shareholders. It increases the wealth of the shareholders. It increases the wealth of the shareholders. Okay. Now we'll come to question number 32. This question is on sensitivity analysis. Question is from May 22 exam. For how many marks? 5 marks. Write down important again. So I will read the question from your book. The question is in your book. P Limited is considering a project with the following details. Initial cost is 1 lakh. Annual cash inflows 30,000, 40,000, 50,000, 60,000. Life 4 years. Cost of capital 10%. Measure the sensitivity of the project to changes in initial project cost. So this is a problem on sensitivity analysis. Okay. So first factor you have to test is project cost. Second, annual cash inflow, considering each factor at a time, such that NPV becomes 0. So two factors you have to test. And in this case, you have to apply sensitivity analysis in such a manner that what should be that cost of capital, cost of project, not cost of capital, project cost, and what should be that annual cash inflow at which NPV will be equal to 0. So you have to do reverse working and find out that value. This is a 5-mark question. To help you, they have given you present value factor also. One last line, identify which of the two factors the project is most sensitive to affect the acceptability of the project. So we have to find first percentage sensitivity. The one which is lower, project is more sensitive to that variable. But first thing first, calculation of NPV, year, cash flow, PV factor, at what rate? At 10% and present value. Listen to me and then write 1, 2, 3, write down 3, 4, 1, 2, 3, 4. Are you there?
Yes, sir.
Or you have gone in sleep mode?
No, sir.
30,000. Keep mobile in sleep mode. You don't go in sleep mode. 50,000. 60,000. Factor you copy from the book. Year 0 I will write below. Don't worry. 0.909. Any other presentation is welcome. Don't worry. 0.826. If you are taught some other presentation, you follow that. Okay. 0.683. Now, learned student will kindly reply the last column. 50,000 into 0.909. 27270. Very good. 33040. 37550. 40980. Wait, so this will be called PV of cash inflows. Yes or no?
Yes, sir. NPV is
So how much is this?
38840.
Total of this, please tell me. 138,840. Then write down less initial investment. Less initial investment, how much is that? 1 lakh rupees? 1 lakh. So what you get therefore NPV? 38840. So this is positive NPV. Original estimate gives you positive NPV. If original estimate itself is negative, there is no need to do sensitivity analysis. Any query on this calculation? So first always you do the NPV calculation on the basis of the original data, original estimate. Now you have to see what is the question. Major sensitivity of the project to change in initial project cost and annual cash inflow. So you have an NPV of 38840. Your initial project cost is 1 lakh. If this number 1 lakh becomes 138,840, your NPV will become 0. So therefore, I have a margin of safety of 38,840. If the initial investment cost increases beyond 38,840, then the NPV will become negative. So write down step 2, sensitivity analysis. With respect to initial project cost. Use the same terminology which the question uses. Okay. So you just write a note for your understanding. If initial project cost increases by, I will write on the next page, by 38840, the NPV will be 0. The NPV will be 0. Therefore, sensitivity percentage equal to NPV divided by initial project cost. This you can apply in every problem for initial project cost sensitivity. So you will get 38840 and divide by 1 lakh into 100. So you will get 38.84%. Is it 38.84%? Step 3. Step 3, sensitivity analysis with respect to annual cash inflows. Now this is again on the screen. Strategy of presentation. The PV of cash inflow is 138,840. Yes or no? If I reduce this number by, if I reduce it by 38840, suppose this number reduces by 38840, what will happen to NPV? NPV will become 0. So this is our margin of safety and this is the base. So the answer will be 38840 divided by 138,840. So that is why I first got this answer in this format. Easy for me to explain and easy for you to understand. Got it? So write down sensitivity percentage equal to NPV divided by present value of cash inflows. So you have 38840 divided by 138840 into 100. 27.97%. Which is lower? The second answer is lower. So write note, project is more sensitive to annual cash flows. Project is more sensitive to annual cash flow because here if it falls by 27.97%, NPV will be 0. But here if it rises by 38.84%, then NPV will be 0. So here a small percentage change can lead to negative NPV. So relatively the project is more sensitive to cash inflow. Is it right? Now we'll come to one question number 25, May 19 exam for 5 marks. This question is based on scenario analysis. Okay. 5-mark question. Bonus marks. As if they are trying their best to pass you, push you. But still you are adamant that you like intermediate so much. Question number 25. Kanuria Enterprise wishes to evaluate two mutually exclusive projects X and Y. Mutually exclusive means acceptance of one will lead to rejection of other. We have to make a choice between X and Y. Initial investment is same, 1,20,000 each. Estimated cash inflow per annum for 8 years. For 8, underline 8 years. For calculation of NPV, you will use 8 years. And there are 3 scenarios. Future can be pessimistic. Pessimistic means worst scenario. Okay, if everything goes wrong, your cash inflow for project X will be 26,000, but Y will suffer more. It will have only 12,000. Most likely scenario, both will give you same cash inflow, 28,000. But in the optimistic scenario, best case scenario, X will generate 36,000 rupees per annum, but Y will generate 52,000 per annum. So in the worst case scenario, X is giving you higher cash inflow. In best case scenario, Y. Let us do the calculation, then we'll discuss. Cutoff rate is 14%, means discount rate. Factors at 14% given to you. So you will use these factors and solve. Advice means you have to answer whether X or Y will be selected. About the acceptability of the project X and Y. So very good question. One by one we'll solve. Write down calculation of calculation of, or when same table should I solve? Okay, same table. Calculation of NPV, calculation of NPV of two projects. It will save time under different scenarios. Under different scenarios. Serial number, particular, then project X will have 3 columns and project Y will have 3 columns. Which 3 columns? Easy mistake. Most likely means average, and optimistic. Everything is going great. Okay. Rahul Gandhi becomes Prime Minister. Priyanka Gandhi becomes Home Minister. Raghuram Rajan becomes RBI Governor again. Mamata Banerjee becomes Defense Minister. So everything going good. That is optimistic. Okay. Arvind Kejriwal becomes Foreign Minister. Whatever you think. So let us solve this amazing question. First point A, write down. Cash inflows per annum. Cash inflows per annum. You have to answer. Project X pessimistic. 26,000. Project X most likely. Project X optimistic. Project Y pessimistic. Project Y most likely. Project Y optimistic. Is it right? Easy to understand? Then you write down point B. PV annuity factor at 8 years, 18 and 14%. So what you do, just please calculate the total of those factors given in the booklet. Don't use own factor. Take the total of the factors given in the booklet. Anybody wants to volunteer? Anybody for 4.639? 4.639. 4.639. Just add those 8 numbers. Now you don't apply extra intelligence, okay? Simply you have to add. And then you get PV of cash inflows. It will be A into B. So multiply A into B, come on. 1,20,614. Very good. 129. Very good. Next one, 129,892. Try again. 167,004. Then next one, 55,668. 129,892. Next one, 241, 228. Any question on this? The answer should flow in such a manner easy to understand. So point number D, right, less initial investment. In both projects it is 1,20,000. So that you write in all columns, because that you will incur today. So that is not affected by future uncertainty. Okay. So that is point number D. So what will be point number E now? NPV, C minus D. Come on. 614, 9892. Without calculator you can try. 47004. Without calculator you can try. 332. This is negative. Then next one is same 9892. Last one is a very big number, 121. Okay, you are too late. I have already done. Now in this question you have to reply which is better. If you look at project Y, it may generate a negative NPV, but project X will generate positive NPV. We don't have to take average, because either it will be this or this. Either it will be pessimistic or most likely or optimistic. You can't assign probability. It is a question on uncertainty. But if the optimistic scenario prevails, X will have lower NPV, but Y will have a very high NPV, which is almost not 5 times, approximately. Who gave you the license to become an intermediate student? 2.57%, and you are saying approximately 5 times. Which country do you come from? Which planet do you come from? Don't be in a hurry. So now I am asking all the students a question. If you are sitting on the decision making chair, which project you will select? Will you select X, which will give you positive NPV in all the 3 cases, or project Y, which will give you negative NPV in pessimistic scenario, but can generate a very high NPV in the optimistic scenario, which is almost 2.5 times of the project X optimistic scenario? So tell me, you have to take a decision. The human being should know one thing which makes them different from an animal. They can take decision. Is it right? Quickly, 5 seconds more. X or Y? One student will prefer X. Yes, come on, next. One student says will prefer Y. And the answer is both of you are right. The one who wants to take a high risk for a high return, is it right? You can go for Y. Like people like you are risk taker only. Do you know that? You are also living under 3 scenarios. Pessimistic, optimistic most likely. Pessimistic you can understand. After so many years of course, suppose it should not happen, but for hypothetical discussion, doesn't pass. Student, suppose there are students in library, you will find they have almost become father of 2 sons, but they are still in final. So they are here. They are still trying, because he knows that if I pass, I will generate a very high NPV compared to other ordinary human beings in this country. Is it right? Otherwise, everybody would have done BCom only. Then why will people come to CA course? Because in optimistic scenario, if he passes in first attempt with rank, his NPV will be very high. But it also carries a very high risk. So risk taker will go with project Y and risk averse investor will go with project X. Write down decision. This time the decision is not either X or Y, it is dependent on risk taker. So write down decision. I will dictate. Write down. Write down, listen to me and write down. Project X gives positive NPV. Project X gives positive NPV. Project X gives positive NPV in all the three scenarios. Project X gives positive NPV in all the three scenarios. Okay. Whereas project Y may generate negative NPV in pessimistic scenario. Therefore, the decision will depend upon the attitude. The decision will depend upon the attitude of the investor towards the risk. The decision will depend upon the attitude of the investor towards the risk. Next paragraph. If investor does not want to take high risk, he will select project X. Next paragraph. If the investor is willing to take high risk, for a high return, in bracket optimistic scenario, if the investor is willing to take high risk for a high return in bracket in optimistic scenario, he will select project Y. And the world is full of such people, okay, who knows that there is a risk, but they take that decision, they take that chance. Is it right? They take that chance. They know that there can be losses, but then they take such chances. So this question cannot have one answer, only project X, because human beings have different attitude towards the risk. When you watch a Kaun Banega Karodpati program on TV, you will find there are two types of contestants. One who says, sorry sir, I don't know the answer, I would quit, I will take whatever money I have earned and I will go home. But there are people who knows that he is taking the risk, but he knows that if I give a right answer, from 50 lakh I will move to 1 crore, but I can lose also. But then why does he reply to the answer even though he is not very confident? Because he wants to take risk and knowingly that he may incur the losses also. If everybody would have taken same decision in the same scenario, then everybody would have quit. Is it right? But no, people take risk and some people want to reduce the risk. So that was the answer of this amazing and wonderful question. So now we'll go to next question. So come to one more important question, number 2020. Question number 20. A&R Limited has undertaken a project which has an initial investment of rupees 2000 lakhs in plant and machinery and 800 lakhs in working capital. Understood? 2000 in plant, 800 in working capital. The plant and machinery would have a salvage value of 474.61 lakhs at the end of the fifth year. So good question. The plant and machinery would depreciate at the rate of 25% per annum on WDV basis. Oh my God, this is going to make your life miserable. Because the WDV method means every year you have to do separate working. The other details of the project for the 5 years are as follows. Sales selling price per unit, then variable cost is 50% of selling price, fixed overhead excluding depreciation 300 lakhs per annum, corporate tax rate 35%, rate of interest on bank loan is 12%, and after tax required rate of return is 15%. So which discount rate will I take? I will take 15%. This is my after tax required rate of return. So we will use required rate of return, desired rate of return, target rate of return for NPV calculation. Is it right? Then what is the question? Similar question we have already done in capital budgeting chapter. Compute the NPV of the project and determine the viability of the project. Okay, determine the viability of the project. Then after that, up to this the life was simple. Determine the sensitivity of the project's NPV under each of the following conditions. Decrease in selling price by 10%. So this time they have given you find the revised NPV assuming selling price will decrease by 10%. And by what percentage NPV would change? Understood? And then we have increase in the cost of plant and machinery by 10%. Now this increase in cost of plant and machinery also means your depreciation will also change. Understood? And these are the factors at 12 and 15. 12% is not required. Delete. This is given to extract money from poor students. Poor in the sense not financially, intellectually. Okay. Some of them will take average also. Possible. Anything is possible in our country. So let us solve. How do I solve? You have sales, selling price, then 50% of the selling price means 250. So question is very easy. It will only take a little more time to solve because of the WDV depreciation. If it was straight line method, the life would have been easier. Say yes. Yes. So write down calculation of NPV. Calculation of NPV. NPV. Right. Format. First step, calculation of NPV. Good question. May 2020 MTP 10 marks. So first write down serial number, particulars, then you write year 0. How many years are there? 5. Year 1, year 2, year 3, year 4, year 5. Presentation can change, but the answer should remain the same. So first point number A, cost of project. How much is the cost of this project? Anybody? Cost of the project? 2000 lakhs. Cost of the project is 2000. Yes, rupees in lakhs, write down. In bracket 2000 in year 0. Point B, write down working capital. Working capital is how much? 800. This also write in bracket. Point number C, write down sales quantity. Sales quantity in lakhs. So read the problem. In the table, sales quantity 10 lakh unit per annum is written. So we write down 10, 10, 10, 10, 10. Then point number B, write down total contribution. Now understand the problem. I will save some space. 500 is the selling price, 50% is the variable cost. So contribution will be 500 minus 50%, 250. 250 is the contribution into quantity. Into quantity. Into quantity. So my question is 250 into 10 you have to do. 250 into 10, 2500. That is contribution. Point number E. Do we have any fixed overhead also? Yes. Less fixed overhead. So fixed overhead will remain fixed only. That is how much? 300. 300. 300. 300. 300 and 300. One more line write down, less depreciation. Method is WDV. Method is WDV. What is the cost of the project? 2000. Rate of depreciation 25%. WDV or straight line? Is it WDV? Yes. So what you do, dear student, 2000 into 25%. 2000 into 25% is how much? 500. Then what you do, if the depreciation rate is 25%, next year you multiply 0.75 into 500. 0.75 into 500 is how much? Now just press equal to, you will get the next year answer. 281.25. Again press equal to 21. Exactly 211. Tell me in two digits. 210.94. 210.94. Again press equal to. 158.20. Either you round off all the numbers or you round off in two digits. Okay. Follow consistency. Any query up to this. You can present in different format. This is simple mathematics. Contribution minus fixed cost and minus depreciation. What will you get? PBT. Write down PBT. Depreciation I have already deducted. So you have to take your calculator. 2500 minus 300 minus 500. 1700. So you write here D minus E minus F. Later on you should not forget. Anybody? 1825. Okay, next. 1918.75. Very good. 1989.06. Very good. Next one. 2041.80. 2041.8. You are getting? Point number H, write down less tax at the rate of. What is the tax rate in the problem? 35%. Wait, I will tell you how to get it fast. First you take 0.35 into 1700. Now just type the PBT and press equal to 638.75. Next year 671.56. Next one 696.17. 696. Only two digits. Last one 714.63. Okay. Wait. Point number I, write down CFAT. So CFAT will be, listen to me, G minus H plus F. G minus H will give you PAT. PAT plus depreciation CFAT. So 1700 minus 595 plus 500. 1605. Very good. 1825 minus 638.75 plus 375. 1561.25. Okay. Next one 1528.44. Very good. Next. Next one 1503.83. Last one, please try. So 1485.27. 14. 1485.37. Point number J, write down salvage value. So salvage value of the project is given. Yes sir, 474.61. Which year? The fifth year. That is 476. 470.
4.6.
Yes, that in the last year. One more point, right? K. Recovery of working capital. Recovery of working capital. This 800 will be recovered here. Is right?
Yes, sir.
Now you draw a line first. L write down. Therefore, cash flow. Therefore, cash flow. Year 0 outflow is 2800. Okay. But for the other 3 years, we have to add these 3 numbers. Am I right? So 1605, 1561.25, 1528.44, 1503.83. These 3 you add. Last 3 figure add. How much you are getting? 2759.98. These are the cash flows of these years. Done? Please check. Answer is not over. You have to compute the present value. So point number, how many points we have written? L. Write M. PV factor at 15%. Year 0 will be 1. Year 0 will be 1. 1 will be 0.869. Year 2 will be 0.756. 0.657. 0.571. 0.497. And write down present value. L into M. So first will be same. How much? 2800 negative. Anybody for year 1? 13.75. Then 1180.31. Okay. 1004.18. Very good. 858.68. Very good. 1371.71. So therefore, NPV equal to, now you will add all these numbers in the last line. Kindly add.
NPV 3010. 3010.
Approximately 3010 lakhs. 3010 lakhs. Note, write down. Note, as the NPV is positive, the project is viable. As the NPV is positive, the project is viable. Any query on this? Now the question is, Determine the sensitivity of projects NPV under each of the following condition. So one by one we'll do. Decrease in selling price by 10%. So write down sensitivity analysis. Step 2. Sensitivity analysis with respect to decrease in selling price by 10%. Decrease in selling price by 10%. Is it right? Right hand side write down rupees in lakhs. I'll just make your calculation little simpler, okay? So first you write down reduced selling price. What will be reduced selling price? 500. Wait, minus 10%. Why are you making calculation which even a rocket scientist will require? 500 minus 10% is the reduced selling price. No, you were saying some other thing.
Yes, sir, now there is no
Less variable cost. So variable cost will also accordingly be 50% of 450. Yes or no? How much? 225. Wait a minute. In the institute answer, they have not adjusted the variable cost. So we will take the same. Only the selling price may change. Material cost may not change. Is it right? So we'll take 250 only. Bracket assuming no change in variable cost. Because what happens? Only selling price can change, but raw material cost, labor cost may not change. So point C, contribution is equal to how much? 200 rupees A minus B per unit. Point D, total contribution is 10 lakh quantity into 200. So now you write in this column 2000 rupees in lakh column. Point E, write down less fixed overhead, that is 300. So point F, write down PBDT. So up to this the format is same. So why to write in all 5 years same thing again and again? Yes or no? Up to PBDT my answer will be same. So we can save time by first just finding PBT. Now write down step 2 or whatever. No, this was step, make it 2A because it is related to same answer. Make it step 2B. Calculation of NPV. So write down first column year, second column PBDT, third column depreciation, fourth column PBT, Fifth column, can I write tax pad directly? How? Okay. I'll multiply by 0.65, or let it be, we will write tax only, otherwise many students will get confused because they are used to writing tax. Then you write down CFAT, PV factor given in the problem, then use it, and last column PV, present value. Similar problems you have done in capital budgeting chapter. Okay, so I will write column number also for more clarity. Column number 1, 2, 3. 4 is 2 minus 3, 5. 6 will be 4 minus 5 plus 3. 4 minus 5 plus 3, or you can say 2 minus 5, or you can say 2 minus 5. 2 is inflow, 5 is outflow, whichever helps you to do faster. Okay, and then column number 7, 6 into 7. So let us write down here 1, 2, 3, 4, 0 I'll write later. 1, 2, 3, 4, 5. PBDT previous step 1700. Can you see 1700? So I have solved in two formats. One the original answer and one this answer. Then whichever one you find it easy, convenient, less time consuming, and depreciation you copy from the previous one. Do you remember depreciation was 500? Same as original answer. Depreciation will not change. 281.25, 210.94, 158.20. Step now 1700 minus 500, 1200. Very easy. Next one, 1325. Next one, 1418.75. Next one, 1489.06. Next one, 1541.80. What is the tax rate? 35%. Okay. Type 0.35 into 1200. 420. Then just type 1325. 463.75. Very good. Next. 496.56. Very good. 5 to 1.17. Very good. 539.63. Now CFAT, either you can take column number 2 minus column number 5. That I think will be easier. 1280. Okay. 1236.25. Okay. 1203.44. Okay. 1178.83. Very good. 1160.37. Factors if given in the problem, copy 0.869, 0.756, 0.657, 0.571, 0.497. Triple one 2.32. Okay. Use memory plus function also, so that you don't have to add again. 934.61. 790.66. 673.11. Okay. 57.70. And first to tell me the total of the last column. Total of the last column. 37. So this we will call PV of cash inflows. There are two more cash inflow. One is salvage value and one is recovery of working capital. Is it right? Just check the total again. Kindly check the total again. I can't take the responsibility for mistake in total. Four zero 4087.4. So PV of cash inflow. Then to that we'll add PV of salvage value and recovery of working capital that we'll receive in the last year. How much is salvage value? 474.61. And how much is recovery of working capital? 800. Multiplied by fifth year factor, 0.497. So this is the PV of salvage value. Anybody would like to answer? Final answer. 3.49. Now write down less initial investment and working capital. Less initial investment and working capital. So in that case, your initial investment was 2000 in fixed asset and 800 in working capital, in bracket 2800. So now I will get my NPV for this revised selling price. 1920.88. This is right. 1920.88. Understood? Original answer was how much? On the screen, 3010. By changing your selling price by 10%, your NPV has gone down drastically to 1920.88. So right below, percentage reduction in NPV. Percentage reduction in NPV. So original answer 3010. This answer is 1920.88 and divided by 3010 in 200. Around 36.18%. Oh my god. 10% decrease in selling price will reduce your NPV by 36.18%. Is it right? Now one homework you do. What is the homework? Second part, that is cost of project. Cost of project increases by, or cost of plant and machinery increases by 10%. So the new cost of plant and machinery will be how much? 2000, it was already there, and plus 10%, 2200. So the depreciation will also change accordingly. Is it right? Depreciation will change. Now wait, so you have to go to the original answer. I will first tell you and then you will solve it yourself. Your original answer will have the following changes. I am going to highlight with a red highlighter. This figure will become 2200. Understood? This will, no, I will not solve. You have to solve. I am just telling you. 2000 will become 2200. Can you do that much? Then here, this depreciation will get affected. So depreciation will be, instead of based on 2000, it will be based on 2200. So this figures will change. Okay, and accordingly your subsequent answer will change. And in the last year, they have not mentioned about salvage value, so we'll take same salvage value. So only what you do, you have to change this to 2200, original answer, and change the depreciation. So accordingly your subsequent answers will change. Can you do that? Because it will just require calculation of same thing with different numbers. Wastage of human time and talent in the classroom. So try this, keep one page blank. This answer is over.